want to go ahead and get things started and welcome everyone to McGuireWoods' New Developments in Tax and Wealth Planning seminar. My name is Bill Sanderson. I'm the co-chair of the McGuireWoods Private Wealth Services Group. I work out of the Washington, D.C. office. And we're glad everyone could be here to join us virtually for this program. And thank you for your patience as we put the program together this year. We thought about having in-person events if it was possible. We decided earlier in the fall to switch to a virtual platform, which worked out well last year. So far, the two earlier seminars have gone well. We hope this one, we know this one will go well as well. And we're looking forward to next year returning in person and continuing the tradition that McGuireWoods established probably 2 decades ago of hosting an in-person seminar. This sort of grew out of our earlier fiduciary advisory services seminar. And we now want to have a broader topic and across multiple offices. When we were planning this, these arrangements, we decided we would host events in 3 locations, in Charlotte, in Richmond, and in Washington, D.C. Richmond, of course, is the headquarters of McGuireWoods, and where a large number of our private wealth services attorneys practice. In Charlotte, Andrea Chimakis and the team have a lot of experience in dealing with banks and trust companies operating in this world. And of course, DC was a natural location because we knew there was legislation coming down. And we thought we'd put it at the end, at the last of the seminars. Surely we would have final legislation by then and be able to have an interesting conversation. Well, as everyone's aware, we don't yet have final legislation, but we do have things to talk about on that. Before we get into it, a few housekeeping items. At the conclusion of this, we are going to send a link to all of the registered participants that includes a video recording of all of the seminars. That's a note to everyone, presenters and participants, to know that this is being recorded. Everyone who's participating will receive a link. And in that link will include the materials. Some have been sent to you beforehand. Some of the PowerPoints that you'll see today or have seen earlier will be included with that. And we'll also include with that a link to materials and instructions so that you can apply for and obtain continuing education credits if you would like to do that. Also, I'm reminded that this platform, which has been so great for holding these virtual meetings, allows participants to ask questions as we go along. There's a Q&A button that you can press, and if you send that, we have people monitoring those. Technical questions you can direct there, or if you have a substantive question, feel free to include, type that in. If possible, we will try to address it as the presentation is going. But it's likely that given all that there is to cover, we won't be able to address it today, but we'll somebody from McGuireWoods will reach out and follow up, at least touch base on it to make sure you got the question answered or if we can help in any way. Before I kick things off and make some introductions, I want to thank our marketing team. Laura Pickert and Ella have helped us put all of this together. We just actually could not do any of this without their help. And right along with Laura are our meeting support and IT professionals that are just invaluable. And they're so competent and able to shift from what we had thought would be an in-person event to this virtual event, and are coordinating across multiple offices, making sure we, the lawyers, know how to operate the technology. And so we are so grateful to them, and we just need to recognize their effort, and we thank them for it. Also want to thank our speakers, including Ryan, who's joining us today, and others for stepping away from what is not always their regular practice group to join and share information with you. So let me go ahead and introduce the folks you'll be hearing from today and give you a sketch of the morning. We're going to start by talking about an update from Washington. And we're lucky to be joined by Ryan Bernstein, who's a Senior Vice President at McGuireWoods Consulting and a real leader in our practice in assisting our clients in dealing with legislative, regulatory, executive branch actions. Ryan has a long career on Capitol Hill, where he served as a chief of staff to a United States Senator from North Dakota. And in that position, he learned not only about how the workings of Capitol Hill go, but he had a front row seat at tax legislation that moved through in the Senate. Of course, the Finance Committee has so much to do with the movement of tax legislation. So his role in the Senate was very, certainly gave him an interesting perspective to what we as outsiders see about that. So in just a moment, we'll get to that. After Ryan speaks, Farhan Zaru and Gino Zaccardelli, our two members of our team in Washington, D.C., are going to kind of move this sort of from conjecture to specifics. We're going to talk about an interesting planning issue, and that is, how should we as planners advise our clients when we're thinking about disclaimers? So many of the things that are happening in Washington are causing changes. And one of the ways that you can respond to changes is to think about disclaiming assets. And so Farhan and Gino have put together some good materials for that. After that, we'll take a short break. We'll come back and I'll introduce our other speakers. Ryan, without further ado, I'm going to look to you on the screen over here and kick it off to you. And thank you again for joining us and sharing your wisdom.
Thanks, Bill. Really appreciate it. And I have to say, thank you for putting me on the hot seat today of all days, planning this tax and wealth seminar. It's incredible timing, I guess, from our perspective on the Hill, trying to figure out what is happening, what's going to be in the final bill, frankly, whether or not the final bill is even going to pass. I think the answer to that is yes. We will see a final bill. We will see something pass the Hill. Frankly, that hasn't always been a guarantee as of late. This has been a very rocky path for everybody on the Hill, inside and out. But it's been, I'll have to say, interesting and kind of fun watching it from this side. As Bill mentioned, I came from the Senate side, where one of the last things I did was work on the Tax Cut and Jobs Act in 2017. And in particular, one of the provisions I worked on fairly closely was the Section 199A. And maybe just jumping way ahead, I think that's going to be safe in this next bill. So personally, I'm glad to see some things that I'd worked on back in 2017 continue to probably be law after this new bill becomes law here this week, next month. But I think that will still be in there. So as you all probably know and hear, that there's a lot of things in flux at this point, and trying to decide how to approach today's seminar without kind of saying definitively what's in and what's out. I can give you kind of the roadmap that has been laid out and kind of likely where we're at and where we're going to end up. So with all those caveats, I have to say that the president is now or is scheduled to be up at the Democratic caucus at 9 a.m. today, pitching this and saying we need to move forward on this. He's going to, as you probably know, head off to Europe shortly. But before he left, he wanted a deal in hand to say this is going to pass before he heads overseas. In large part because he needs to get this moving, but also because he's heading to a big climate conference in Glasgow, Scotland, and he wants to announce that we put together a massive clean energy tax provisions that will help spur green investment in the United States. I think those provisions are safe. They're about $500 billion, so it's a big package here, and it's very important for everybody. But will I get done? Well, we'll see. We'll start diving in here and kind of going through it and kind of come to the end, and I'm sure you're going to have a lot of questions. As Bill mentioned, I'm free, others are free to answer this, and we'll continue to update this, of course, as other things continue to roll out. But so where are we right now, and what are the dynamics at play, which kind of, in the end, drive what will be in this large Build Back Better plan? Well, this was really priority number one for the president when he campaigned and when he took office. But as things happen, nothing really goes as planned for a president. First out of the gate, he had to deal with the COVID issues. So they came back, they did another rescue plan. That was about $1.9 trillion. So that was $1.9 trillion in the books, spent. That caused some pause and concern for some of the moderate Democrats moving forward. So what happened after that? Were they going to move to the Build Back Better bill? Well, there was a lot of issues with that can only move through on a budget reconciliation, which we'll talk about later, which requires just all Democrats, no Republicans to pass. That kind of took a back seat to some Republicans getting together with some moderate Democrats and saying, hey, I think we can pass an infrastructure bill here. Let's move on with that first. Well, when they started planning that, then because Republicans were part of those negotiations, the first bright line rule from the Republicans was like, if you want us to negotiate and work with you on an infrastructure project, there can be no tax increases whatsoever in this package. So all tax increases had to be pushed off again to the Build Back Better plan. So what did they do in the infrastructure? They basically went and found some kitties to take about $1.2 trillion out of. That was basically a lot of clawback from other unused money from the COVID money, like $53 billion from states that haven't used their federal unemployment insurance supplements, like $106 billion from unused paid and family leave tax credits. So you can argue, was this real money or not? It doesn't matter really sometimes in Washington, D.C. The CBO says, Congressional Budget Office says this money is money that that's been spent. So if you pull it back, it can count towards paying for your infrastructure plan. So that was $1.2 trillion. So now you've passed already, since the president took office, a $1.9 trillion COVID package. Now the Senate has passed a $1.2 trillion infrastructure package. So now, how much are you going to pass in the Build Back Better Act? And how are you going to pay for those priorities? Well, where do we look? Where do we look to figure out what they're going to do? And really, we got to start with the Green Book. It's something that we call here in Washington, D.C., basically the administration's revenue proposals that they put out every year. And sometimes they're pretty general, but it gives us a decent idea where they want to go. The president put it out in May of 2021 and basically said, here's what I want to do. He had two plans that he talked about during the campaign, and he really merged them together. There was the American Jobs Plan, which was kind of his infrastructure plan to start with, that ended up still being his infrastructure, but maybe more of a green infrastructure plan after the bipartisan infrastructure bill passed the Senate. And then the American Families Plan, which I guess he would call it his human infrastructure plan. It's much more of the Medicare and college and pre-K type of plans. So how is he going to pay for both of these plans? Well, generally, he wanted to reform the corporate taxation, support housing and infrastructure, and clean energy out of the American Jobs Plan. And for the American Families Plan, he was going to increase the individual income tax rate for high-income taxpayers, close loopholes, and improve tax administration, which is pretty general. And again, some would question how much is really going to come into the additional coffers by improving tax administration. But that's what he laid out to try to pay for this. Now, the question was, how much revenue will this generate, and how much do they need to do the American Jobs Plan and the American Families Plan? Well, I think the administration was saying they would need about $4 trillion. I think if people on the Hill really broke it down, I think they would say it's closer to probably $5 trillion plus dollars. So that's a lot of revenue they had to come up with. And if you remember, the infrastructure bill that passed the Senate, the bipartisan one, kind of already took a lot of this easy, low-hanging fruit pay-fors and used them up. So now they got to do the hard work. They got to raise taxes. They got to figure out how they're going to pay for all the rest of this. So that's where we kind of jump in here to talk about what was on the table from the administration's perspective. Then we're going to move in to talk about what is on the table from congressional perspective. And then we're going to do a little bit of forecasting at the very end about what is probably in, what is probably out at this point. And again, all of this could change very soon. Just one more item of context before we kind of really jump into this. There's a disagreement, as you probably heard, on the Hill about how this is going to roll out procedurally as it relates to the infrastructure bill. And you probably heard it's messy. I want to say that it's even more messy than you probably are hearing on TV. The president's likely going to come out this afternoon and say he has a framework for the Build Back Better bill, and therefore we can pass the infrastructure bill today or tomorrow, with the understanding that the text is basically being written right now for the Build Back Better bill, and therefore that'll come very shortly after you can pass the infrastructure bill, because they need to pass the infrastructure bill before the 31st, because that's when the highway transportation bill expires. They could always do another patch, which I think they probably will end up doing. But the progressives want to see the actual text and a commitment from frankly Manchin and Sinema that they will support something that's acceptable to the progressives in the Build Back Better plan. That's still to be seen. Progressives say they won't vote for the infrastructure bill until they see the infrastructure bill passed. Sinema saying she won't pass and support the Build Back Better bill until she sees the infrastructure bill pass. So you got progressives and moderate Democrats saying exactly, frankly, the opposite. So we will see who wins that argument. But over the last 24 hours, I think they've made good progress on, we'll say, the taxation side of things. Is that good or not? I think that's up to be debated, but I think that's kind of at least the state of the play right now. We'll talk more about that as we get into talk about the congressional side of things. But as far as the administration, what did they want to do? Well, I think this has been pretty well publicized, but just a good reminder of what they wanted to do. They wanted to increase the top ordinary income tax rate from 37 to 39.6% for effective tax years beginning after 2021. And that top tax bracket threshold would be indexed for inflation. They also wanted to look at tax capital gains and qualified dividends. They want to tax those at ordinary income tax rates, with frankly the highest rate of being 43.4. If the ordinary rate increases to 39.6, and then you add that together with the net investment income tax of 3.8%. So that's for taxpayers with an income of over $1 million. Take a look at this one too. I might just point out as we go through ones that you might want to take special note of as it ties into what might be in the final bill. They want to extend the 3.8% net investment income tax to cover all business income of taxpayers over $400,000. They want to extend the 12.4% Social Security tax to wages and self-employment earnings for people above $400,000. As you heard during the campaign and from a lot of the Democrats in Congress, they made a pledge not to raise taxes above 400, or people making less than $400,000. As we'll talk about through the seminar, who is rich, who's uber rich, who's beyond rich, has all kind of come up here in discussions about where those thresholds should be. But 400,000 is where we all started, and it'll be interesting to see where we end up as about who is rich and who should be taxed, frankly. On the corporate side, a lot of conversations about the corporate tax rate. The administration wanted to increase the corporate income tax rate to 28% from the 21%, effective for the tax years beginning after 2021. And I should point out that basically everything we're talking about, from what the administration wants to do and with what the congressional Democrats want to do, your effective tax rate, this is basically after December 31st, 2021. So beginning at the new year is when they're really looking at these things to take effect. I had a point in here. These slides were done over time. So things keep changing, of course, but, Manchin wanted to settle on 25%. So you'll see where the House Democrats wanted to be, you'll see where Manchin wanted to be, and then we'll see in the end where they actually might end up. But that's what the administration wanted to do. Take a note of the second point here. They wanted to impose a new 15% minimum tax on corporations with worldwide pre-tax book income of at least $2 billion. Take a note of that one. And then also take a note of this one. They wanted to increase the effective rate on GILTI moving forward. So we wanted to replace BEAT with SHIELD and impose an additional limitation on interest deductions by multinationals. So you'll see some of those additional points pop up pretty soon. So carried interest and like-kind exchanges. Especially the like-kind exchanges have been a real focal point of the administration, some Democrats, but a lot of pushback in the Hill. But the administration wanted to tax carried profits, interest coming from ordinary income, and that's subject to self-employment tax for taxpayers whose income exceeds $400,000. And they wanted to limit the like-kind exchanges, basically aggregate of the amount of $500,000 per year per taxpayer for $1 million for married individuals filing jointly. This has kind of popped it up almost every debate that we've had on taxes, even back in 2017, and continues to come up here as something that is some of the Democrats in the administration want to really go after. But this has had a lot of resiliency, frankly, over the years to stay in place. So, but take note of the carried interest. The other thing I just want to mention that's probably not exactly on point, but it kind of goes right into like how much money they need to come up with. They want to make permanent or expand certain existing credits for low income and other taxpayers, including premium assistant tax credits for those purchasing health insurances through the ACA and earned income tax credit for workers without children, and a child and dependent care tax credit, child tax credit, and employer provided tax credit for businesses. Note the child and dependent care tax credit is a major contention right now. That may still be in the bill in the end. So what bill are we talking about? What is budget reconciliation and where we are in the process? I tried to highlight a little bit about this earlier, but as you know, probably reading through the news and everything going on, the budget reconciliation is basically a process where the Democrats or the Republicans use this to pass the 2017 tax cuts. The Democrats are trying to use this to increase taxes to pay for all of these items. A budget reconciliation bill, really the genesis of this was to basically see if you could reduce the debt and deficit of the federal government. Has it done that? No, it's probably been used the opposite, to increase the debt and deficit both ways. But it does have a lot of rules around the budget reconciliation process. And you probably heard of something called the Byrd Rule. That really kind of limits what can be in the budget reconciliation bill. Only policy that that basically affects the debt and deficit can be included in this bill. So that really has knocked out a lot of things, likely knocked out a lot of things. The parliamentarian in the Senate is the ultimate umpire on this, calls balls and strikes. You probably saw that they wanted to increase the minimum wage. Elizabeth McDonald, who is a longtime parliamentarian for the Senate, has said that even though you might see some additional taxes come into the coffers, that doesn't satisfy the Byrd Rule. That doesn't affect the debt and deficit. That's out. Immigration. Democrats are pushing very hard to have the immigration included in the budget reconciliation bill. That's likely will be out too as a violation of the Byrd Rule, which people on the Hill like to call bird bath, giving these provisions a bird bath. And if you drop out, they like to say it's the bird droppings that drop out. It's what we do on Capitol Hill. Everything gets kind of dry, so you kind of have to come up with clever statements, I guess, with a lot of these provisions. So those things are out. Some labor issues wanted to come in. Those are likely out. But so you need everybody, as you know, you need all Democrats to sign on this bill. As you know, in the Senate, there's exactly 50-50 Republicans and Democrats. So as the president says, every senator that's a Democrat feels like they're a president. And in the House, you only have a 3-vote threshold for the Democrats in the House. You cannot lose really any Democrats in this process, which makes it very difficult. So where did they start then? You remember the president wanted probably a $4 to $5 trillion Build Back Better plan. Bernie Sanders wanted something probably closer to $10 trillion, and the progressives wanted something closer to $10 trillion. Well, they scaled all of this back and put forward a budget reconciliation bill that authorized spending up to $3.5 trillion. The Senate passed that bill, which basically just authorized the Democrats to start drafting legislation for $3.5 trillion. Well, Manchin and Sinema said, fine, starting the conversation. There's no way it'll be close to $3.5 trillion. Democrats then started writing their tax policies, negotiating back and forth, and right now we're talking about a $1.75 trillion package, roughly. So we're at now about half of where we were at when we started this budget reconciliation process. So what does that mean for Texas? They need to come up with a pot of money that they can pull out of to fund their priorities. And where are they going to find this? At the time, they were thinking about $3.5 trillion. Now they need to come up with about enough money to fund a $1.75 trillion package. Senate has been really kind of quiet on the formal process. The House, back in September, mid-September, started working, putting together the actual text of the legislation and passing it out of committee. So in mid-September, the House Ways and Means Committee, led by Richie Neal from Massachusetts, started putting together their priorities. So I want to lay out what the House priorities were, irregardless of what the president wanted and the Senate wanted. So this is what the text is out there. Again, we'll take note of some things that we think are very important moving forward. But again, you'll see this constant theme. They wanted to modify the individual income tax that are on high-income individuals. They wanted to increase the top individual marginal tax rate to 39.6%, seeing that's very constant for tax years before 2026. As I think probably everybody at this seminar knows, there were some hard decisions made from a Republican perspective on the 2017 tax cut bill, what was going to survive long-term and what was probably going to sunset. The decision back in 2017 was to have the corporate rate basically move out past the 10-year window where the scoring happens, where you have to account for the spending. But to save a little money, they dialed back the individual tax cuts and had those expire after 2025. So really what we're talking about here, if we change any marginal tax rates in the top, that has to be before 2026. House also wanted to change and modify the taxes on long-term capital gains and qualified dividends, including the increase in the top tax rate to 25%, have an application of the net investment income tax to trade or business income for certain filers. Take a note of this one. Making permanent the net investment income tax one, take note of that one. And then making permanent limitations on excess business losses for non-corporate taxpayers and establishing a surcharge on high-income individuals' trust estates. Take note of that one. So those are some of the top lines there. They also wanted to increase the corporate income tax rate to 26.5%, a little lower than the president, a little higher than what Manchin wanted, and wanted to have modifications to the treatment of international taxes that would generally increase revenues. Take note of the guilty one, of course, too, and then the foreign tax credit limitations. Those are things that are going to continue to come back into play. And they wanted a temporary extension and modification of the child tax credit, still on the table. So that's where they wanted to be on those. They also wanted to make permanent extension and enhancements of the dependent care tax credit and earned income tax credit, extend certain tax credits for electricity, which we probably won't get into too much here, other than those were expensive and they were going to have to pay for them somehow. So getting kind of really into the weeds here, what would they do on the corporate rate? They want to increase tax rates on the first $400,000 of taxable income so that would be 18%. Taxable income over $400,000 but not over $5 million would be taxed at 21%, and the taxable income over $5 million would be taxed at 26.5%. Tax income over $10 million would be subject to an additional tax equal to 3% of the amount of 10%, and then cap it at $287,000. Let's take a note of that, and we'll come back to that one a little bit later. They do want to also limit deduction on interest expenses. So we won't touch base. These slides are available for everybody. I don't want to get completely into a lot of these too far because we'll get back to some of these. This one's another very important one that I want to come back to again on GILTI. As you probably know, how GILTI works now after the 2017 law. What they're looking at is now the provision in the Build Back Better bill would accelerate the 37.5% deduction for GILTI and the 21% moving forward. Whether or not that sticks, I think that's probably very likely, to be honest with you. This all kind of ties into GILTI, but it would impose separate, would impose the limit separately for GILTI on a per country limit versus the aggregate that we're looking at this point. They also want to modify the BEAT and raise that from 12.5 in 2024 and in 2025, and 15% thereafter. We talked about this one earlier. They did come through and they had a provision that would increase the top marginal individual income tax rate to 39.6 starting in 2022, and the marginal rate would apply to taxable income over $400,000 for unmarried filers, $425,000 for household filers, $450,000 for married filing jointly, and $225,000 for married filing separate. Then they also have a capital gains rate, of course, that we talked about. The provision would increase the top capital gains rate on assets held for a year or more from 20 to 25%. And the 25% rate would apply only to those subject to the top marginal individual tax rate. So, mention this on a highlight, but take note of the net investment income tax rate. The provision would subject the active income of high tax partners and S corps that are not already subject to FICA and SECA tax to the 3.8% net investment income tax. The high income thresholds would be at $250,000, married filing separate, or $400,000 for single household, or $500,000 jointly. Here's that 199A I mentioned. The House wants to basically limit the dollar amount of the 20% of the Section 199A deduction for pass-through businesses. We'll see. I think that one is likely going to survive. There's a couple of things here I just wanted to talk about that is probably not necessarily in a lot of your wheelhouses, but just take note that one of the things they are doing that we'll have to watch very carefully on is for those that run businesses, there's probably some policy that they're putting in this bill and putting a tax or a fine or penalty on it to help satisfy that bird rule we talked about. So some of the interesting things I wanted to point out is they want to impose, frankly, a $10 per participant per day fine on, they say tax imposed on employers failing to maintain an automatic contribution plan or arrangement. I think this is, for employers with 5 or fewer. Does not apply to employers with 5 or fewer employees, and they begin in 2023. And wanted to increase the credit limitation for small employer pension plans. This is just some of the things that they're kind of working on. Talking also about additional contribution plans. I won't really dive into this one too much further. Same thing with they're trying to increase some saving, and I just put this up here for anybody that has an interest in some of the retirement provisions that have been looked at in the House bill. Same thing with some of the safety net items that they have. This is just additional things that are on the table that they may have to pay for moving forward. And of course, the child and dependent care credit that we've talked about in the past. So, and some credits for caregivers, and trying to change some healthcare tax credits. Want to leave this up here and have this for a resource for you guys when you look through the PowerPoints later on, because I really wanted to kind of get to, I think a lot of people talking to Bill and others, where are we and where are we going to be here? What are some of the big ticket items that are on the table at this point? Ironically, how this is kind of played out, and I think there's a lot of question on whether or not Senator Manchin, and in particular Senator Sinema, wanted us to get to this place. Manchin has been pretty clear for a long time what he wanted. He had a very big concern about the green provisions, green energy provisions in the bill, and he thought $3.5 trillion was too high. He wanted something around $1.5 trillion, but nobody really knew where Senator Sinema was. She was pretty quiet through the whole process. Well, where did she kind of really come out of the woodworks proposing lately? And I think it kind of probably surprised a lot of people if this was either how it fell into her lap or whether or not this was her long-term goal. But I think she wanted to have a larger discussion about our current tax code. And she actually put a stake in the ground saying, look, I don't want to do any increases again that we saw during the 2017 tax debate, increasing those marginal rates again. She's like, I don't like the marginal rates on the income tax for the individuals and the increase in the tax rate for the corporations on the marginal rate. On the corporate tax rate, which kind of, I think, threw a lot of things in flux from their perspective and from the Democratic perspective. So they really kind of had to go back to the drawing board. And I think Senator Warren saw an opportunity there to come up with something that they thought, hey, look, if you're not interested in raising money through basically marginal increases, is there anything that you'll look at in doing back to my mark-to-market system or a corporate profits minimum tax rate? I think to some of the progressives' surprise, she said, yeah, I'd be interested in that. So in the last week or so, we've seen Congress really try to figure out, okay, if we're not going to raise in the top marginal rate on income, individual income, and if we're not going to do an increase in the tax rate from 21% to 25 or so, what else can we look at? Is that really off the table? Well, Richie Neal in the House says, look, this is well defined. We know how it works. Let's move forward with it. But Congress right now is looking at a couple of very interesting items that I wanted to highlight here. So this mark-to-market system, the billionaire's income tax. I have a colleague here, Stephanie Kennan, that worked for Senator Ron Wyden. And she can tell you personally, Ron Wyden has a lot of ideas. and a lot of ideas on how to raise taxes in some very interesting ways. And he's been waiting years to put forward what he calls the billionaire's income tax. So he was working on it. He popped it out, frankly, the other day. And it would require people who have more than $1 billion in wealth or earn more than $100 million for 3 consecutive years to pay taxes on assets they hold, even if they don't sell them. One of the biggest items he added in there is it would impose a one-time tax on all the gains that had been built up before tax had even been created. And so basically, as they like to point out, you'd have Bezos and Elon Musk probably paying something like 500 or 50 billion, 40 to 50 billion dollars in taxes on that unrealized increase in wealth that they have, and they would give them 5 years to pay up to about $50 billion. And then after that, after the 5 years, they would charge capital gain taxes on any subsequent annual appreciation. And really, the easy part of that from their perspective was you could look at what stocks, bonds, and other publicly traded assets would be worth, and then you could tax on the assets as they are at the end of the year. The other part that was getting very tricky, if this wasn't already tricky enough, was how do you evaluate real estate ownership stakes in privately held businesses that are taxed after sale. And what they want to do is then look at the tax rate that they would have faced if they were publicly traded after the sale, and kind of a reach back. This, I don't know if the first point, if you will, the one-time tax or the stock bonds tax would have flown on its own. But I can tell you that last point about figuring out how to tax real estate ownership stakes in privately held businesses, I think probably will kill this billionaire's income tax proposal. You saw Manchin come out and say he doesn't like it. He's going to oppose it. Rich O'Neill, again, the main tax writer for the House, says this seems really complicated. You'll see senators like Senator Tester come out and say, this seems really hard and it's very dangerous to move forward with something that's so untested. The other issue is it only reaches about 700 people. It'll raise about $200 to $300 billion, which is quite a bit of money. But then there's also, as I put in here, a question about the constitutionality of this plan, because as you know, you can't tax individuals, and this could directly and go after people. So this may not be a broad enough plan. So right now, honestly, Wyden is still pushing, and Senator Warren is pushing very hard for this plan. I don't think it survives in the end. Manchin basically poured some cold water on it hours after it came out. But it's in our business, it's always interesting to take note what's out there. This has made it farther than it's ever made it before. Frankly, there hasn't been much text on this in the past, but now we have text on the billionaire's income tax. It's out there. It could move forward in the future. Don't think it's going to be in this current plan. So what else is also on the table at this point? So the corporate profits minimum tax. We talked about the increase in the tax rate on corporations from 21 to 25 to 26. To a lot of people's surprise, Sinema did not like that. So what are they going to do instead? Well, let's call it a patriotic tax, right? That might make people make this more palatable to people. This one, I think people are rallying around and will likely see in the final bill. This will require companies that report over $1 billion in profits to pay a minimum of 15% tax on the profits. It does do a couple of things. It does preserve the value of business credits, including R&D, clean energy, and housing credits. Allows for credits that are paid to foreign countries, and allows for carry forward losses in future regular taxes. I think from what I've heard, this one is pretty palatable to everybody. This is another big push by Senator Wyden, Senator Warren, and you'll even see a couple of moderates that are okay with it. And I think Manchin said he's probably okay with this one also. So where does that leave us? The other big thing I wanted to kind of put up there is SALT, of course, too. The state and local tax that was imposed in the 2016, a cap on it in the 2017 tax bill. That was done in large way to pay for the tax cuts in 2017, thinking that, look, brass tacks, just telling you how we thought at the time, that was going to have basically the blue states help pay for the tax cut. And obviously with the Democrats now in power, this is one of the big issues that they have, especially on the coast. There's probably maybe a dozen Democrats that say they need to see the SALT cap changed, and I think they'll get that done in the final bill. They will probably have a 2-year lift on the cap on SALT. So that's where I think they're probably going to land on SALT. We've covered a lot on the taxes that the Biden administration has put forward, the taxes that the House Democrats have put forward, and frankly, some taxes that have come out of the blue from the back pockets of several senators that have been thinking about these issues for a while, and several things that they're just writing on the back of an envelope at this point, to be very honest with you. So I know you all kind of want to know, where is this going to be? Well, here's our best guess at this point. This is very much changing. The president's going to come out today and say they likely have a framework. He's likely going to come out today and say they have a framework to move forward on a, say, a $1.75 trillion package. Let's move forward with the infrastructure plan. I think they are pretty close, as I mentioned, on coming together with enough taxes to pay for that 1.75. The tax part is tricky, but it's almost becoming the less tricky part about what's in, what's out, maybe, generally within the Democratic caucus. What is tricky now is the priorities that they still need to pay for. Whether or not the increase in Medicare expansion is in or out is still up for debate. Free college tuition is out, pre-K, we'll see. So there's some dividing lines between the progressives and the moderates. So they got to figure out how much they need to raise to pay for this. But I think they are coming kind of together on about 1.7, 1.8 trillion dollar package. And they think they can get that by looking at the following items, including, as we talked about, the corporate minimum tax. I think looking at including the net investment income tax, moving guilty to 15%. And then as they come up in the last kind of rallying around in the last 24 hours, something we kind of touched on earlier, is this surtax of individuals over $10 million. What they're looking at doing is including an additional 5% income, a tax on income over 10 million, and an additional 3% on top of that on an aggregate gross income of over $25 million. Generally, they think that could get them close to the 1.75. They don't think they probably need the estate tax provisions, the gifting provisions that were talked about earlier that we didn't really cover, but some of those things that you probably all know. 199A that we talked about, probably don't need that. Carried interest, probably don't need any changes to that. And because frankly, cinema, probably don't need changes in the corporate ordinary capital gain rate increases. Again, I know a lot of talking to Bill, a lot of interest in the grantor trust language. That one has been very politically problematic for a lot of people in Congress both ways. It raised a good amount of money, but there's been a lot of pushback on that. So, don't want to make any predictions on that one. I can just tell you that there's been a lot of pushback on that one in Congress. So we'll see what the final language is. Happy to try to push that out to anybody that's interested in that after we start hearing a little bit more from today's meetings. But that one is a little bit more problematic for a lot of Democrats to support a change to that. I think the billionaires thing is out. The IRS reporting requirements, we've all probably heard about this, turn frankly more political than probably revenue-based. Democrats were looking at trying to increase auditing, et cetera, for the IRS. Manchin hates it. Democrats really want it in, so whether or not the banks have to check how much money has come into your bank account and out is still up for grabs, but it's not a tax increase at this point. So that's a lot on the table, to be honest with you. So we're trying to boil it down. That's where we're at this point. As of when I walked in here at 9 o'clock, things could have changed since then, but I think it's important for all of us to have this discussion about what taxes are now on the table, and as we point out, are now, as we say out here in DC, on the shelf. So even if these things don't pass now, you have items that have been vetted, you know where people stand, and in the future, if things aren't adopted in this Build Back Better plan, you may see some of these things pulled off the shelves and used to pay for things down the road. So we always got to keep an eye on those provisions. But for now, I think generally we're looking at the minimum tax, net investment income tax, GILTI, surtax on those making over 10 million, and probably putting more money into the IRS so they can audit people. I think that's kind of probably largely phantom money, but CBO says that if you increase auditing, you'll get additional money back into the coffers. I think they can cover their package now with those provisions. So, not done. I don't think that this passes this week. That's my putting that out there. They're going to try very hard, but they're trying to write this. The ink's not dry yet, and things could change. But hopefully, we have a better clue on this in frankly by November. I think we will, because everybody thinks that Congress will turn into a pumpkin, frankly, in 2022 and nothing really passed. So they want to see this done now so they can move on to the other debates getting closer to the midterms. So I appreciate everybody kind of going through this and their interest in it. And it's been interesting to watch from our perspective as this continues to change day by day, all the way from it's going to happen to it's not going to happen to it's going to happen, but here are the provisions that are in and out. And as you can see, as we get close to the bottom of the ninth inning, I guess, while it's the World Series, you get some pretty unique, out there, unvetted proposals. Some will make it in, some won't, and we'll continue to follow. So if you got any particular questions, as Bill mentioned, email us. And if there's something that I can look at, make some calls to the Hill or whatever, give you the best indication we can on what's happening, we'll do that, and we'll definitely follow up with everybody once the tax bill is actually drafted and put out there. We'll put together summaries on this. So appreciate everybody today. And with that, I'm going to make my transition over to Gino and Farron to talk about disclaimer planning. Thank you.
Thank you.
Yeah, thank you.
Thank you, Ryan. Hello, everyone. My name is Farhan Zaru, and I'm an associate here at McGuireWoods, and this is Gino Zaccardelli, who is a partner at McGuireWoods, and we are both part of the Private Wealth Services Group. I am based out of here, DC office, and Gino is based out of the Tyson's office. But like I said, we're both in the Private Wealth Group. Thank you for joining us today. The main topic of our discussion is disclaimer planning, as you may know. And so we'll be doing a brief dive into some issues, some topics, and some planning structures. The first part of the talk, which I'll be handling, will be more statutory, rigid, and then Gina will take over and do some more fun stuff, some planning and some stories and structures. If you have any questions after our presentation, feel free to email either of us, and then hopefully we can give you a response to your question. Let's get started. Great. I'll start this discussion off with just a brief overview of disclaimers. I'm sure most of you, if not all of you, have encountered disclaimers in some way or another throughout your career. But as a quick reminder, a disclaimer is a refusal to accept the ownership of property or rights in property. Disclaimers are the method by which a formal rejection of a gift or inheritance takes place. And so Gino and I will get into more detail about this, but the freedom to accept a gift or inheritance through a disclaimer comes with important tax consequences and limitations. Importantly, it also offers opportunities for gift and estate tax planning. And as the slide says, typically gifts and inheritances are readily accepted by the recipient, but that's only if they so choose to do so. The reasons that a recipient might refuse a gift or inheritance is typically a gift, a tax goal, or a family goal. So maybe a family goal would be a recipient is much better off financially than they were at the time the plan was put into place. And so they have no need for the asset or the property. Alternatively, a taker in default could need the property when the plan was put into place. So a disclaimer of the primary beneficiary to the remainder could make sense because that person needs the assets, which was not expected. A tax goal could be to fix an overfunded or underfunded trust, to cure defects in marital deduction planning, or to create a charitable deduction that otherwise would not have been available. These are just a few examples, but Gino will touch on a little bit more details later on in the presentation about some tax reasons to disclaim and whatnot. So especially in today's environment, and as Ryan was just talking about, tax laws are a day-to-day thing. They could change at any moment. And so disclaimers can prove to be more and more valuable as times are getting, there's changing. And so the disclaimer can provide that flexibility and can allow you to delay decisions or fix mistakes or just adjust to the laws that are in effect at death or during a gift. So disclaimers can be very powerful and can leave that flexibility when otherwise you would not have that flexibility. And then the last point on the slide there about state law and federal law. So disclaimers are the property passes by state law, but the federal tax consequences are governed by federal statute. So the interplay of those two statutes is key, and being able to weave and make sure everything is satisfied can prove to be really important. Otherwise, there could be some unintended results. All right, so the key provisions for disclaimers is located in Section 2518. And so to avoid adverse federal transfer tax consequences as a result of a disclaimant must meet the requirements of 2518 to be a qualified disclaimer. You should note that 2518 applies to interest created after December 31st, 1976. And so that's when the statute was enacted. Before then, disclaimers were governed by IRS regulations and case law. I won't go into much detail. I may touch on it later on. But disclaimers before that date were governed by case law and regulations. They're still very relevant today. A lot of trusts were created back then. And so they are still very relevant, and we see them in our practice frequently. But they're a lot more flexible than today's rules. So I won't dive in too much into those cases, but just be aware that they exist, and that if you see something that seems to be a little bit older, it's something to look into. And so, as the slide says, a qualified disclaimer is an irrevocable and unqualified refusal to accept interest in property that satisfies 4 requirements. First requirement is that the refusal is made in writing, identifies the interest, and is signed. Second, the written refusal is delivered to the transferor, his or her legal representative, the person holding legal title to the property, no later than 9 months after whichever is later of the date the transfer creating the interest occurs, or the day at which the disclaimant turns age 21. So it's the later of there, which can be very important. The third requirement is that the disclaimant has not accepted an interest in the property or any of its benefits. And then the last requirement is the interest passes without any direction on part of the disclaimant and passes either to the spouse of the decedent or to a person other than the disclaimant. And so those are the 4 big requirements, and I will touch on those in this slideshow. But essentially, 2518 lets the recipient make a gift to the next in line recipient free of additional transfer tax. So, typically, if you were to receive an inheritance and give it to your children or whatnot, it would potentially be subject to gift tax. But the disclaimer rules allow you to make that transfer without using up your exemption or exclusion or anything like that. So it could be a powerful planning tool. And so while local law may be important to identify who the transferee may be, the transfer does not need to satisfy local law requirements under 2518, so long as the transfer is carried out in accordance with that state law. And so the transferor's direction of the transfer to the individual who will have taken it under local law will not be construed as an acceptance of the property or any of its benefits. So that's an overview of 2518. So now I'll touch on the first requirement in writing. So that's pretty straightforward. The refusal must be in writing. The writing must identify the interest in property disclaimed and be signed either by the disclaimant or the disclaimant's legal representative. The writing must be delivered to the transferor of the interest, the transferor's legal representative, the holder of the legal title to the property, or the person in possession of such property. Pretty straightforward and simple. However, compared to state law, this is a breeze. Under lots of state laws, and especially the uniform states, there are very specific requirements for delivery and for filing a disclaimer. I know here in DC, there are a number of certain fact patterns where you would have to file the disclaimer with the probate court. And so states tend to be a lot more specific with the filing requirements. And it may not be parallel to the federal requirements, and it may actually require you to deliver the disclaimer to someone that is not in possession, or they may not hold legal title. And so it's always important to be aware of the differences between the two, because delivery may have to be different under state law and under Section 2518. The next requirement is the in-time requirement. And so, as we talked about earlier, a qualified disclaimer must be made within 9 months following the date that the transfer creating the interest was made, or the disclaimer's 21st birthday, whichever is later. And so the 9-month window starts at different points for different interests. So an inter vivos transfer, which would be a lifetime gift, if I just give Gino $100, the 9-month window starts from the date that the gift is completed. So not if gift tax was paid or anything like that, it's when the gift was complete. For transfers at death or transfers that became irrevocable at death, the 9-month window starts at death. For general powers of appointment, the holder of a general power of appointment, the 9-month window starts from the creation of the power. So that's important to note. And then the holder or the appointee of an exercise or lapse of a general power of appointment have 9 months from the lapse or exercise. And so after the holder of the power of appointment either doesn't exercise it or releases it, then whoever is the taker in default would have 9 months from that point. And one interesting to note is the holder of a limited power of appointment and permissible appointees and takers in default for all limited power of appointments. The 9-month window starts from the transfer that created the power. So one key takeaway there is to consider disclaimers by descendants after the death of the first spouse, because under many estate plans, it may be too late for children to wait until death of the surviving spouse to make that disclaimer. So limited powers appointments can be tricky, and it's always to be aware of where they are and when how to timely make a disclaimer. Like we talked about earlier, pre-1977 disclaimers are treated differently. And like I said, those are more flexible and just less rigid time requirement. And so for those interests, it's a reasonable time period after knowledge. So that's a lot more flexible, given that wide latitude of reasonable time period after knowledge. As you can see, the statutory framework does not have any knowledge requirement. And so with the rise of silent trusts, it's interesting that how that's going to play out when beneficiaries and takers in defaults don't even know the trust exists, let alone know that they are a beneficiary of that trust. And so there's no safe harbor for knowledge here, and so that's a tough situation and something to think about whenever creating or administering silent trusts. And so it's really, as you may see, it's really important to meet these strict rules. And so I'll quickly cover Technical Advice Memorandum 2004-37032. In this memorandum, a decedent left the residue of his estate to his sister, who was a member of a religious order who had taken a vow of poverty. The order was the taker in default, so it went to the sister, and then if she didn't survive the brother, then it went to the religious order that she was a part of. The sister was also the personal representative of the brother's estate, and she, after the 9-month window, she transferred the property to the order as a disclaimer. And the issue is whether this qualified for the charitable reduction for the estate. And so the IRS first addressed this issue of whether the gift to an individual, which the individual was required to transfer to a religious organization because of a vow of poverty, would qualify for the estate tax charitable deduction. The IRS found that the property did not pass from the decedent to the religious organization pursuant to the terms of the brother's estate plan. Rather, the property passed from the estate to the sister, and then pursuant to a contractual agreement, the sister transferred the interest to the order. And because the bequest did not pass directly to the order, the IRS said this does not qualify for the charitable deduction. The next issue was whether the sister's vow of poverty constituted a qualified disclaimer and met the requirements of 2518. And it's pretty obvious that it did not, because there's no writing. And the IRS agreed with that and said that the vow of poverty does not meet the requirements of 2518. It also did not satisfy the state law requirements for a disclaimer, such as being filed with the court. And so the vow did not have the effect of treating the sister as being predeceased for inheritance purposes. In addition, the IRS concluded that the transfer of the assets to the order did not meet the requirements of 2518C3, which treats certain transfers that don't otherwise qualify as a qualified disclaimer relying on the fact that the sister did not meet state law requirements, and there was a state law process for disclaiming those assets. So this ruling points out the importance of strictly following the terms of 2518. And one of the most important and most, least followed provisions of that statute are the 9-month requirement, either because it's just so quick after a death, or it's just forgot about. And so the failure to obtain the charitable deduction in that scenario could have been avoided if the requirements of the statute were met and the state law requirements were met. The next third requirement is the no acceptance requirement. So the disclaiming person must not have accepted the interest or any of its benefits prior to making the disclaimer in order for it to be a qualified disclaimer. A qualified disclaimer cannot be made if the disclaimant has accepted the interest sought to be disclaimed or any of its benefits, either expressly or impliedly, before the disclaimer. Acceptance is manifested by an affirmative act, which is consistent with ownership of the interest. And so a few examples of what expresses an ownership interest are on the slide: using the property, accepting dividends, interest, rents from the property, or just income from the property, directing others to act with respect to the property. Another example would be pledging the property for a loan, or even accepting consideration in exchange for the property. So like a side deal where you agree to disclaim for a certain amount of consideration would be deemed an ownership interest. A general power of appointment, also the use of a general power of appointment also constitutes acceptance. In Engelman versus Commissioner, there was a joint revocable trust, which upon the first spouse to die, entirely funded Trust A, and then if the surviving spouse disclaimed, it went to Trust B, and so upon the first spouse to die, the surviving spouse exercised this power of appointment, and by directing the trust assets, but then she died a month later after the first spouse to die, and her estate administrator tried to disclaim the assets, saying it was within the 9-month window, and that the assets should go to Trust B. And the IRS said, no, you can't do this. It's ineffective. And it was not a qualified disclaimer because the surviving spouse accepted the benefits of the property by exercising the power of appointment in her will. And then on the other hand, there are acts that do not constitute acceptance that may look like acceptance, such as mere acceptance, like holding a deed or holding a stock certificate, and so those aren't treated as acceptances by the IRS. A fiduciary who holds property in that capacity, in and of itself, does not constitute acceptance. And then operation of local law, so a joint tenancy at the death of the first spouse, the property vests in the surviving spouse. So that doesn't mean that they accepted the property and they still have that time period to disclaim. And so one private letter ruling on this point is 2005-03024. There, the IRS ruled that a surviving spouse's disclaimer of one half of the survivorship interest in a joint brokerage account was a qualified disclaimer, even though the surviving spouse had withdrawn from the account, had sold securities within the account, and had purchased securities in the account prior to the date of the disclaimer, and this was after the death. And so the surviving wife changed title on the brokerage account to her name only following the death, and she did all those things: withdrawal, sold, bought. And so she specifically disclaimed her husband's 1/2 share of the account, less the assets that she benefited from after his death. And so the account was divided into 3 sub-accounts: one for the wife, one for the estate, for the estate, and one as tenants in common. The tenants in common account held securities that could not be evenly divided. And that included assets that the wife sold or purchased after death. The remaining assets were divided between the wife's estate account and the estate account. and the wife's account held assets that she had contributed during her lifetime, and the estate account held the rest. And so the IRS said that that's a qualified disclaimer, even though she had sold, withdrawn, and purchased assets within the account. And so a key takeaway there is, those facts look bad. She took the assets, she sold the assets, she did acts that were demonstrated ownership, but they still allowed it. So it's always something, even if you have bad facts, it's always something to pursue if possible. And so the no direction requirement is the last one here, provided that a disclaimed interest must pass without direction on part of the disclaimant to a person other than the disclaimant or to the surviving spouse. And so a disclaimant may not direct the redistribution or transfer of the property to another person unless it is limited by an ascertainable standard. So if an interest in property is disclaimed by a decedent's surviving spouse and passes without direction, it passes without the direction, even though the spouse is a beneficiary of the disclaimer, and it will still be considered to be a qualified disclaimer. However, if the surviving spouse or another disclaiming beneficiary retains the right to direct beneficial enjoyment of the disclaimed property, that disclaimer will not be qualified unless the retained right is limited by an ascertainable standard. And so generally a person may make a qualified disclaimer even if the interest in the property, after the disclaimer, the person has fiduciary power to distribute the property to beneficiaries so long as it is limited by an ascertainable standard. So, an individual can disclaim property that was to go to him or her, and that person could be the trustee of the resulting trust. And so long as those distributions are limited by an ascertainable standard, health, education, support, that can still be treated as a qualified disclaimer, and that person is not treated as still holding the power to direct beneficial enjoyment. So it's important to note, in drafting trusts or reviewing trusts, to make sure that in the event of a disclaimer, that person is limited by that ascertainable standard. And so, like I said, the trustee of a trust, so long as it's HIMSS or ascertainable standard, can hold that fiduciary position and not have to worry about retaining the direction power. And so the last point there, if there is an express or implied agreement that the disclaimed interest in property is to be given or bequeathed to a person, that will not be a qualified disclaimer. So it's important to be mindful of facts that would suggest an arrangement to compensate the person that is disclaiming. So transfer of funds immediately after the disclaimer or services rendered are all facts that could hint at the fact that there was some sort of agreement between the parties to disclaim. Sorry, I skipped over. So those are the four big requirements that I just talked about. And so, as I mentioned at the beginning, state law governs the property aspects of disclaimers. And so 19 states and DC have adopted the Uniform Disclaimer of Property Interest Act. And so the Uniform Act differs a lot of ways from 2518, and the main one being there's usually no deadline. A 9-month deadline doesn't exist, but it also imposes other strict requirements such as filings and delivery. And so, as you can imagine, state by state, disclaimers differ. And so it's important to be aware of what state you're in when making a disclaimer. And so on this slide, I've listed a few considerations when looking at disclaimers under state-specific law. And so file with the court. Here in DC, there are circumstances where you must file with the court. Delivery, like I said earlier, the delivery could be to someone that doesn't have possession of the property, unlike the federal statute. Timing, maybe none. DC, for example, there is no timing requirement. And then so there's also the importance of looking of how the disclaimed property will pass. So if there's no taker in default under the trust instrument, you'll have to look to intestacy laws under that state, and different states can vary on how their intestacy laws operate. And so it's important to get a good handle of how those work. What may be disclaimed? So it's an interest in property. And so each interest or power with respect to the property that is separately created by the transferor generally is treated as a separate interest. Thus, assuming that all of the requirements for a qualified disclaimer are met, one can make a qualified disclaimer of one interest in corpus while retaining a separate interest in corpus, or they could retain a power over trust income or principal while retaining other rights or powers over trust principal or income. Under the regulations, a power of appointment is regarded as a separate interest in property that can be disclaimed separately from other interests. So, for example, one may disclaim a testamentary power of appointment over trust principal while retaining a lifetime power of withdrawal or an interest as a discretionary distributee of income or principal. In addition, one may make a qualified disclaimer of a specific amount in a trust, provided that no income or other benefit of the disclaimed amount goes to the benefit of the disclaimant after the disclaimer. And so one case I wanted to touch on was Walshire. It's a 2002 case from the Eighth Circuit. The court held that a disclaimer of property with a reserved life estate is not a qualified disclaimer. The decedent in this case had been the primary beneficiary of his brother's estate, and he had executed a disclaimer of the remainder interest in the estate, but reserved the life estate for himself. And so upon the brother's death, the decedent's death, the executor did not include that asset in his estate, and the IRS asserted that the asset was includable because the disclaimer of the remainder interest was not valid based on the Treasury regulations. The estate contested the validity of the regulations, and the Eighth Circuit found the regulation was valid. The court noted that although the statute allows for a disclaimer of any interest in property, this must be read within the context of the section, and the court found that an undivided portion of an interest that does not separate out the bundle of rights does not qualify as a qualified disclaimer. And so here because the decedent disclaimed a remainder interest, which does not include the immediate right to immediate possession, it did not qualify. And so based on this analysis, the court determined it was reasonable for the IRS regulations and that the division of property must be vertical. So it must meet the definition of undivided interest. So it needs to be all of the interest in that portion of the disclaimed property. And so who may disclaim? So both individuals and those acting in a fiduciary capacity, executors, trustees, agents may disclaim interests and powers under the appropriate circumstances and with the appropriate authority. If a would-be disclaimant is incompetent, such as a minor, incapacitated person, an effective disclaimer may or may not be possible depending on the state law and the facts surrounding the disclaimer. And so, like I said earlier, it's important to look at state law to see, if that person has the power, and if so, how they do so. And so that's important to look at. Joint property. So the regulations provide that if property other than a joint bank account or brokerage account or investment account is held by tenants by the entirety or joint tenancy, the disclaimer must be made within 9 months after the creation of the tenancy. We touched on that a little bit earlier. And then so the same scenario, but a survivorship interest must be made within 9 months after the death of the co-tenant. And so the regulations apply regardless of whether the joint interest was unilaterally severable under local law while all the joint tenants were living. If under local law a joint account cannot be unilaterally regained by a contributor to the account, then a qualified disclaimer of assets must occur with 9 months of the contribution to the account. So that's important to note that there's some tricky merger statutory requirements under within some states that are good to be aware of. And so one example, and this one's pulled from the regulations, a husband and wife had a joint account, a brokerage account, in which the wife contributed all the funds, and then at the creation of that account, it was not a completed gift because the wife retained assets. And then at the wife's death, one half of the account would be included in her estate under 2040, and that asset would receive a step up in basis. And so the husband can disclaim his survivorship interest in the account because he did not contribute any funds to the account. If he does just make that disclaimer, the 1/2 interest will pass through the wife's estate plan, and it will receive a full step up. The remaining 1/2 interest would be treated as joint and receive a 1/2 step up. So the property disclaimed by a spouse can pass back to the spouse, and therefore the disclaimed portion of the account in this example could pass to the deceased spouse's will to the under the deceased spouse's will to the surviving spouse or marital trust for his benefit. And so by disclaiming, the spouse could receive assets in the account with a much higher basis than he otherwise would. So there's some creative basis planning that can go on, and Gino may touch on that later when he talks about some planning and structures. And then the last point that I will talk about is asset protection. And so disclaimers can be a very advantageous way from asset protection perspective because it's treated under a lot of states as if the disclaimant had never obtained the asset or an interest in the property. So the outcome is that the disclaimant has never received the property, and so a creditor would have a hard time attaching to that asset because the person had never received the asset. And so this is referred to as the relation back doctrine in a number of states, and some states such as Texas have statutes that specifically lay that out, that say that the asset is treated as never being received by the disclaimant and having been received by the eventual beneficiary. And on the other hand, some states prevent valid disclaimers from circumstances such as the disclaimant's insolvency. Minnesota has a statute that says a disclaimer is barred if the disclaimant is insolvent at the time it becomes irrevocable. And so many states also disqualify disclaimers for Medicaid qualification purposes. And then the United States Supreme Court has determined that a disclaimed property can be reached by the federal government in satisfaction of a federal tax lien, even when there was a valid disclaimer under state law. So the federal government can get those assets. And so the one case I wanted to bring up on this issue is Drivers United States. This is where a disclaimant owed the federal government around $300,000 in unpaid taxes, and he inherited assets from his mother, and he was around that same value, and he was insolvent at the time, and so he disclaimed under state law, and so the property passed to his daughter. The government wanted to foreclose on its lien and sell the trust assets. The Supreme Court held that the state property law had no effect on the ability of the federal government to reach the disclaimed property to satisfy its liens, and that the right to inherit in a property is subject to a federal tax lien, and that the fact that the inheritance is subsequently voided by a state law disclaimer does not affect the government's ability to attach to that property right. And so that's it on asset protection. And I think Gino will take over here to talk about some structuring and some planning aspects for disclaimers.
Yes, thank you, Farhan. We'd now like to talk a little bit about planning options with disclaimers, just taking some of the stuff that Farhan laid out for us and just putting it into plans that we put together and advice we give clients of how to potentially use disclaimers. We see it kind of breaks into two basic categories. One is post-mortem planning options. That's where in preparing a plan, we anticipate ahead of time that a disclaimer might be an option that could be used after a person's death. The second option is the section plan option is fixing an estate plan. That's where you find some kind of mistake in the estate plan after a person's death, and you figure that using a disclaimer may fix the problem. For me, what's common about these situations is that in the end, they're not used that often, at least in my practice. For example, when you have post-mortem planning options, it's just an option. It just applies in estate administrations, and then you don't use it in every estate where it's an option. And there's not too many situations where you're certain to use a disclaimer that you put in an option as a plan. Then when it comes to mistakes, you hope that you don't make too many mistakes in your own plans or even find mistakes in other people's plans. So because it's not that common, every time we use a disclaimer, we tend to think very hard about whether we can use it and how we actually will use it in that circumstance to make sure we get it right. So in some ways, it's kind of a complicated planning tool when you get down to using it, because again, it's something that's thought about a lot, but not necessarily used often. So let's talk about just the first item, a few post-mortem options. The first type of planning we use quite a bit is planning on the death of the first spouse. The idea is to give options to the surviving spouse that the surviving spouse can consider in the 9 months after the first spouse's death. One plan is to give the spouse the option of creating a trust. The plan is to have the estate pass in full outright to the surviving spouse. The surviving spouse, however, can disclaim any part of the estate that the surviving spouse receives or should receive. And when I say any part, I mean any part at all, because as Farhan kind of discussed, disclaimers can be general and broad, like saying, hey, look, I disclaim everything and I don't want anything, or they can be very precise, almost surgical in their precision, and you can disclaim just specific items, specific assets, or even specific parts of assets. And one option can be when the spouse disclaims, it will go into a single trust. Usually we make it a credit shelter type trust. In other words, it's a trust that does not qualify for the marital deduction. So any property passing into this trust will use the estate tax credit of the first spouse. The surviving spouse can decide how much property passes into the trust. The spouse can disclaim enough to use all of the first spouse's credit or less than that. In fact, the surviving spouse could even disclaim more than the first spouse's estate tax exemption and pay estate tax if that's what the surviving spouse wants to do. The second option for a single trust is a trust that does qualify for the marital deduction. Whether it gets the marital deduction, because it's usually set up as a Q-tip trust, depends on if the executor makes the Q-tip election for the trust. So if less than the amount of the first spouse's exemption goes into the trust, the executor probably wouldn't make the Q-tip election, and at that point the trust will act like a credit shelter trust, and it won't be included in the surviving spouse's estate on the surviving spouse's death. If more than the first spouse's estate tax exemption goes into the trust, then the executor can divide the trust into two trusts and make the Q-tip election for the trust that has more than the estate tax exemption amount. So in the end, you do have an effectively two trusts: a trust that doesn't have the marital deduction, that has the full credit and is not taxed when the spouse dies, and then the other trust that has the marital deduction, so that there's no tax due on the first spouse's death if the surviving spouse disclaimed more than the estate tax exemption amount. And this really is used for clients, as you can understand, who really aren't sure if they want a trust on the surviving spouses, on the first spouse's death. Especially now that we have portability and you don't lose the first spouse's exemption if it's not used when the first spouse dies, there's just less reason to create these kinds of trusts. These are for clients who are comfortable knowing that all the property passes outright and free of trust to the surviving spouse, and the surviving spouse will create the trust and only fund it with what the surviving spouse decides after the first spouse's death. So the surviving spouse, after the first spouse's death, can meet with his or her advisors and make the decision of whether to have the trust and how much that goes into it. The other type of planning we sometimes do, instead of having a single trust, we have the property pass into two trusts. In this situation, the will or the revocable trust will itself have the standard formula for allocating the property between the marital trust and the credit shelter trust, and the surviving spouse will just disclaim whatever the surviving spouse wants to disclaim, and the formula will have it pass into the credit shelter trust and the marital trust, and so there won't be any tax due. It'll just pass by the formula in that way. And as Farhan said, the spouse can be the trustee of the disclaimer trust. But as Farhan said, there's two things to watch out for. One, if as the trustee, the surviving spouse has discretionary power to distribute property among beneficiaries, that power's got to be limited by an ascertainable standard. If it's too broad, it won't be a qualified disclaimer because the spouse has that power to direct. The second thing is the spouse shouldn't have the power of appointment the surviving spouse should not have a power of appointment over that disclaimed property at the spouse's death. It's nice to give the surviving spouse that kind of flexibility, so at the spouse's death, he or she can direct how the property goes. But if you give that power of appointment, you have to have it limited by an ascertainable standard. And it's somewhat unusual for us to draft powers of appointment where it's limited by an ascertainable standard. Our practice generally is just not to give the surviving spouse a power of appointment, as opposed to drafting a power of appointment that is limited by an ascertainable standard. Another type of planning, which again Farhan talked about, has to do with joint property, right? Some spouses really just like to hold all their property, or at least most of it, jointly. For example, joint accounts are easy to set up and use, and on death, it passes automatically to the surviving spouse without doing anything. There's also creditor protection. States like Maryland, D.C., and Virginia, and quite a few others have tenancy by the entirety, which give great creditor protection. And when you talk to clients about that, they like it because only a creditor of both spouses can reach the property at all, right? A creditor of just one spouse can't reach the property in any way. So some spouses just don't like to give all that up and want to keep it joint. So when the first spouse dies, right, what happens? It all passes to the surviving spouse and does not use any of the first spouse's estate tax exemption. But what if you want to use some of this property to use the first spouse's estate tax exemption? Or what if you just would rather have it pass into a trust for some other reason? Well, as Farhan said, you can disclaim the property. And anything that's disclaimed, the client needs to know it will pass into the first spouse's probate estate. So if the surviving spouse disclaims any property, it'll just pass through probate now. So this shouldn't be used if a person really doesn't want to have probate. That's something that you'll just have to deal with when you disclaim jointly held property. Then once it's in probate, it'll just pass into the credit shelter trust or the marital trust, just as I described earlier. Basically, it just picks up the plan at that point, and the trust and the surviving spouse can either have further disclaimer rights, or there can be just a formula that creates those two trusts. Now, one question that does come up when you disclaim joint property is how much of the joint property can the surviving spouse disclaim? And again, Farhan touched about this, and the regulations really cover two categories. And this is a relatively tricky part of disclaimer planning with joint trusts, joint property. There's two categories. One is joint bank, brokerage, and investment accounts. The other category is everything else, like real estate or interest in entities like limited liability companies. For the everything else, like real estate or interest in entities, the spouse can disclaim up to 50%. So up to 50%. But what about the joint brokerage, bank, and investment accounts? Like Farhan said, what you do look at is you look to the spouse's contribution to the account. And you can disclaim everything except what you've contributed. This is the general approach. So normally, for most long-term planning, you'd like it to be something where either spouse can disclaim half, so that you have some flexibility depending on which spouse dies first. But if one spouse really did put in 100% of the assets, of the contributions to the account, that spouse can't disclaim any of it. The alternative is the surviving spouse, the other spouse could disclaim everything. But if you have the spouse who dies, who put the property into the account, dies first, that spouse isn't going to disclaim anything. So this joint property plan isn't going to work. So normally, when we set this up and we think there's a good chance they may do this, we try to think through how do we get the spouses to have 50% in the account. So each of them contributing 50%. And there's a couple ways to do it. One, you could create an LLC, and then when it's funded, where the money comes from isn't as important, because the spouses will own the membership interest as jointly. Because that's not an interest in a joint brokerage account or an investment account, that interest in the LLC can pass. The interest in the LLC can pass 50% on the death of either spouse. The other way to do it is you could just make sure that when the account is created that they put 50% in each. They could set up separate accounts, divide their assets into separate accounts, and then fund the new joint account that you are thinking about disclaiming with 50% each. So each of them will contribute 50% to that account. And then you don't really have any issues of worrying about whether on the death of the first spouse, whether you can disclaim 50%. So as Farhan said, there are state law rules that apply when you're doing disclaimers of joint property, and you just want to think through to make sure you can understand what's going to happen on the death of either spouse. Another plan you can do with post-mortem planning has to do with children. As Farhan said, children can disclaim what they receive just as spouses can. The child may do it because the child just doesn't want to receive the assets because of maybe a creditor issue, or because the child simply has enough money. In that case, the property typically passes to the child's children, who are the grandchildren of the decedent. So now that we're dealing with grandchildren, you have to deal with a generation skipping transfer tax. Now there is that rule that says that if a child dies before the decedent, the grandchild gets a step up in generation assignment, so that when property passes on the decedent's death to their grandchild, it is not a generation skipping transfer, and you don't pay generation skipping tax or have to deal with the generation skipping tax. But that only applies when when the child actually does die before the parent. A disclaimer often is treated as if the child had predeceased the parent, but that does not apply here in the generation skipping transfer tax. So the disclaimer does not in any way step up the generation assignment of the grandchild, and you still have to deal with the generation skipping transfer tax aspects of this. Another thing to think about is successive disclaimers. You don't have to just do one set of disclaimers. There can be more than one disclaimer involved in any plan, any post-mortem plan. For example, the spouse can do some disclaiming, the property would pass to the child, and then the child could disclaim again and pass it on down to the grandchild. Some plans we put together, or some situations we find there are multiple disclaimers of interests or just powers. But the one thing to remember is the 9-month rule. The 9-month rule applies to all those disclaimers at a person's death. So there's no ability to extend that 9 months, and you've got to coordinate with everybody to be sure that everyone does their disclaimers within those 9 months. So those are some of the post-mortem planning options that we do. Those are the most typical ones that we do, and clients seem to really like that flexibility, and knowing that they can decide after death how the property passes. So then we've got some other issues, which is the kind of second topic there, is fixing an estate plan. Generally, this is the category of items where something is wrong with the plan, or maybe something could just have been done better. And whenever you find yourself in that situation, do think about disclaimers. They don't always apply, and they may not always be available, but you should think about them. They really can come in handy. So what are some of the mistakes or things that you can fix? Again, this follows up on some of the stuff Farhan talked about. For example, in the spousal disclaimers we were talking about, if we did have the spouse disclaim into a trust, but that trust was improperly drafted with a broad discretionary standard with the spouse as the trustee, we can do a disclaimer of that power and disclaim it back down to an ascertainable standard, or disclaim it, completely. So that's one way we can fix a plan. We also talked about, what about that power of appointment? If a surviving spouse has a power of appointment in a trust they want to disclaim into, well, we can disclaim that power of appointment so that the surviving spouse won't have the power to direct in that trust. What about if there is a problem with a trust, somewhat unrelated to the surviving spouse? Let's say there was a trust that you really want to qualify for the marital deduction, and there is a problem such as that there is a discretionary power to give distributions to a child, right? For a marital trust to qualify for the marital deduction, so the surviving spouse can be the only beneficiary. So in this case, if you've got a child who is a discretionary beneficiary or any other person, the child can disclaim that interest in the distributions, so that the spouse will still be the only beneficiary of the trust, and it can qualify for the marital deduction. Another kind of problem might be where a trustee has a power as a fiduciary that you don't want that trustee to have. Sometimes it's related to tax reasons, sometimes it's related to other reasons. Again, a trustee within 9 months can disclaim those powers. And we've been talking a little bit about trusts here. Some of these kinds of problems you have with trust can be fixed in a different way sometimes. Typically, we try to reform trust sometimes, because under most states' trust codes, there's an ability to correct mistakes, or there's just an ability to amend the trust using things like non-judicial settlement agreements. And that might be an option. But those things tend to involve more than one person. Sometimes they even need court approval, and there's a lot more moving parts to it. A disclaimer typically just has one person filing a relatively simple document. It has to be done properly, and you have to think it through, but it's really just one person doing it, or it's a bunch of people doing it separately. So it doesn't quite involve as much coordination, and you also often don't need court approval, which you sometimes do in some of these judicial settlements. Another thing that you can think about in terms of fixing a problem has to do with or doing a disclaimer, is with trusts that were created before 1977. Because as Farhan said, those trusts, or any interest created, so a trust that's created before 1977, or an interest that was created under a will of someone who died before 1977, we use the old rules. And one of the biggest differences is that the time for making the disclaimer is when a reasonable time after you discover you have the interest, after you get knowledge you have the interest. And that can be quite beneficial. For example, there's a case where this is again a pre-1977 interest was created. You had a life tenant and a remainderment, and the life tenant lived for many years. And when the life tenant died, the remainderment disclaimed that remainder interest. I think it was 6 months after the life tenant died. But that was 19 years after the interest was created. And under the old law, that was allowed. So if you have a trust that was created before 77, think about how the disclaimers might be able to help you. Now, the knowledge issue is something to be concerned about if the person does have knowledge. And the idea that the person doesn't have knowledge over a long period of time might be an issue you have to deal with. But if you've got good facts on that, it can be used, and just keep that in mind. Another fixing is if you've made a gift maybe and decided that in the end you don't want to make that gift. And this started coming, these kinds of discussions came up in 2012, which has a lot of similarities to this year. If you remember in 2012, at the end of 2012, the exemption was scheduled to go down from 5.1 million back to $1 million. This is a scheduled reduction. And in 2012, we had people who were thinking about making gifts before that reduction happened, before we lost that $4 million of exemption for each spouse for people who hadn't used their exemption. And of course, people were hoping that Congress would extend or make permanent the $5 million exemption, but we didn't know. And in fact, I'm sure you remember, Congress finally did extend it, actually made it permanent, but they didn't do that until, I wouldn't say it was the last second. I think they did it just slightly after the last second they could have done it, because they did it on January 1, 2013. I remember it happened basically on New Year's Eve. So we didn't know until the very end whether or not it was going to expire. So people felt the pressure to make these gifts, to use their $4 million exemption. But some people wanted to have flexibility to have the gift reversed if the exemption was extended, right? They would not make the gift otherwise. And disclaimers were sometimes thought about to be used in that planning. For example, because remember, the way disclaimers work is a disclaimer, when someone disclaims, the document can direct what happens to the disclaimed property. So you have the ability to put that into the trust. And one plan with disclaimers is that the beneficiary would just disclaim the interest. So you made the gift, let's say in December, but you've got 9 months until really September to decide whether you want to do a disclaimer. So the idea was you could wait to see whether or not the exemption, the $5 million exemption, was going to be extended. And if it was, then you could do this disclaimer planning within the first 9 months of the year. So one thing would be the beneficiary would just disclaim. And if the trust was drafted properly and the state law allowed it, it could pass back to the donor, back to the person who made the gift. Another thing that was interesting was, and this we never even really considered, was the idea that the trustee itself could disclaim the property. Not the beneficiary, but the trustee, who's not a beneficiary, would actually be able to disclaim the property within 9 months and have it go back to the grantor, the person who made the gift. I don't know if any of us anyway, really got comfortable that could be done. But the idea is that if the document was drafted properly, a trustee could make that disclaimer. It always brings up issues of fiduciary duty, whether the trustee should be doing that and giving property back to a grantor. But that is something that was talked about. The other thing is, another plan with a disclaimer was what you would do is you would put the property into a trust that qualified for the marital deduction. So you'd put it into a trust that could be a Q-tip trust. And if the exemption was extended and you didn't need to use the exemption because you still had it, then the trustee of the trust would make a Q-tip election. It would make a Q-tip election, that way it qualified for the marital deduction, and it would not use any of the first spouse's, or excuse me, the donor's exemption. Now, one issue with that is that in order for it to qualify for the marital deduction, usually the way it's drafted is the spouse has a mandatory income interest. And that sometimes isn't a good thing for a trust where you actually are not making the Q-tip election because you needed to use the exemption. So in that case, the plan was the spouse could disclaim then disclaim the income interest. So because you had a trust where you'd rather not have the income go to the surviving spouse after you've allocated exemption to it, and hopefully it's passing really to the children. And this way, only distributions could be made to the spouse. The spouse could actually disclaim the entire interest in the trust, so the spouse wouldn't even have an interest, or they could at least disclaim the mandatory income interest. And these are the kind of things that we're thinking about even now potentially, because the same thing is the exemption going to be reduced? Should we be including this kind of options into a plan in case someone would rather not use the exemption if it's going to stay as is? But if it stays as is, I guess we'll be thinking about this in 4 years when it's scheduled to go down and be cut in half in 4 years. So issues just keep coming back around. The other thing is just disclaimer mistakes. Sometimes you try to do a disclaimer and you just don't do it right. And one case I'd like to talk about, it's kind of an old favorite of some people. This is a case from 2010. It's Brake Iron versus Gudanis. And in this case, you had a husband and wife, and they had 2 adult children in their 20s, and they wanted to give them their residence, their personal residence. And so what they decided to do is they split the house, the residence, into 2 tenant and common interests, and Dad put his 50% interest into one trust, and the mother put the other 50% interest in the other trust. And these were structured as Cuperts, qualified personal residence trust, and they had a 10-year term. So the mother and father retained the interest in the house and the use of the house for 10 years. And at the end of the 10 years, the property passed to the 2 children. They had a son and daughter, 50-50. Well, the 10 years passed, and the property now was going to pass to in full ownership to the son and daughter. And the son, though, he wanted his sister to have the house. He really didn't want it. So he was wondering, how can I give my 50% interest to my sister? So he went to a lawyer, and the lawyer said, well, look, the disclaimer, the Cuperts just ended, the 10-year term just ended less than 9 months ago. All you need to do is now make a qualified disclaimer because you've still got 9 months from the end of the Cupert, and that will pass to your sister free of gift tax because it's a qualified disclaimer. So based on his lawyer's advice, the son made a qualified disclaimer he made a document that was called a qualified disclaimer, and the property passed to his sister. Now, under state law. Now, some of you probably are picking up the mistake here in this plan this lawyer came up with, which is the 9-month period. The 9-month period for disclaiming wasn't after the end of the 10-year term. It was at the creation of the Cupert. So the son was about 10 years late in this disclaimer. And by the way, it's easy to think this lawyer made a mistake, and it certainly was a mistake. But I can the way the state tax works. In some ways, he did know that if the spouses died during the trust term, during that 10-year term, it would be included in their estates for estate tax purposes. So the sense that maybe it wasn't kind of a completed gift until the until the person actually survived the 10-year term, I can maybe see how you can get turned around a little bit if you just don't actually know how the estate tax works. I think that's what happened here. It can, this artificial world we've created of how the estate tax works doesn't always seem logical to everyone. And that's why sometimes you just need to know the rules instead of just kind of trying to see how they work. But anyway, so the son ended up making a taxable gift of $2.3 million. That was the value of the gift on the tax on his gift. And of course, he didn't like that. So they went to court and tried to see if they could rescind the disclaimer based on mistake. The idea that, hey, look, if I had known what the real law was, I wouldn't have made this disclaimer. And the court looked at it and agreed. So the court rescinded the disclaimer based on Massachusetts law. So the disclaimer was rescinded, and the property went back to the son. He got his 50% back. Now the question, of course, comes up is whether this applies to the IRS and whether the IRS is bound by this. Does it have to not assess $2.3 million of gift tax? And, the issue is kind of interesting. The issue is not totally clear. There's a line of cases that says that in these kind of state cases, the IRS is not bound by this, because often you have, two people, a brother and sister, who are involved in this case, maybe a lawyer who's also involved in this, and they don't really have any interest in generating gift tax. So this mistake idea is open to collusion between these parties just to not have the IRS get a gift tax. So in that way, for that reason, the IRS is not bound by this case. The other line of argument is that, well, if it's not a gift didn't happen, and so there's no way the IRS can impose a gift tax because you only can impose it on a gift. Well, in this case, the court weighed both those options, and they ruled in favor of the son. So the son did not have to pay the $2.3 million gift tax. One thing was interesting. One of the footnotes, the court said, the IRS's position here is that by not making this a qualified disclaimer, is the son is going to have to pay $2.3 million of gift tax on this transfer. The son's gotten it back. So if the son wants to give it, for example, to his sister, well, he's going to have to pay another $2.3 million of gift tax. So they pointed that out. I think that's where the court maybe was coming from, that this is a bit harsh. But the truth is, it is harsh. It is harsh. If you mess up a disclaimer and it's not a qualified disclaimer, you've got to deal with the gift tax aspects. And one thing about this case that people were talked about a lot in 2012 when we were making those gifts at the end of the year, the idea was that, hey, maybe we can use this to rescind a gift, on the idea of, hey, look, I made a gift at the end of 2012 based on the exemption going away. But if, in fact, it was extended, I wouldn't have made the gift, so I should be able to use rescission to have the gift returned to me. As you can see, it's a slightly different situation between a mistaken disclaimer and wondering what Congress is going to do. But the idea of rescission was talked about when we were making these gifts. And to the extent we're making gifts this year, and being worried that the exemption will go down, maybe we'll hear about rescission too. And maybe this case will come back up if it turns out people made gifts that they would rather not have made. So that's what. Farhan, do we have time? Did you have? Are we getting near the end?
I think we're near the end. We got everything.
Well, Farhan had a really good one too, but that one
we'll save it for later.
We'll save Farhan's mistake case for later. And I don't think your case has as good a result for the taxpayers as this one. No, well, sometimes the taxpayers okay, sometimes they're not. So.
All right. Well, thank you guys.
Hello, everybody. My name is Bill Sanderson again, welcoming everybody back to the break, and welcoming everyone back from the break. And before I turn the panel over to Megan and Laura to talk about fiduciary cases, some interesting fiduciary cases, I want to say that Ryan, our first speaker on the updates in Capitol Hill, predicted exactly what would happen. In fact, during the time that he was speaking, President Biden released both a framework and a fact sheet related to the provisions that he would use to pay for the spending priorities in the Build Back Better plan. I'll just give you the quick highlights, and that is Ryan sort of predicted where this was going, which was that there would be a surtax on AGI of $10 million or more, and changes to the net investment income tax, the applicability of that, and lots of other corporate and related and adjacent changes. Most importantly, or from what we're seeing now, nothing related to the grantor trust rules or the estate tax exemption amounts, or even the wealth tax or mark-to-market provisions that he spoke about. I asked Ryan just to confirm, what does this actually mean? And he said that it is the framework that President Biden believes will pass the Senate. There are still negotiations to be had. It is not by any means final, but interesting that where we landed was on a surtax on adjusted gross income, effectively raising the rate on the highest income earning taxpayers. Yet to be seen how quickly this moves, but that looks like the framework that we'll be operating from. So with that in the books, and now want to turn over the microphone to our colleagues, Megan Hubbard and Laura Meese. Megan and Laura sit in the Richmond office, but Megan is working on and trying cases not only across the whole state of Virginia and in the DC and Maryland area, but also across the country. And she, together with other folks at our team, monitor cases that are being reported out of every jurisdiction that we can find, and sifting through those, not only to report on them to everyone, but to spot trends in fiduciary cases. And this is something Megan knows as much about as anyone, and she's going to spend an hour or so with Laura talking through what are some updates that we need to be thinking about when we're thinking about trustees or representing trustees or serving as trustees. So Megan and Laura, thanks for all your hard work on this, and look forward to the hour.
Thank you, Bill. Good morning, everyone. As Bill mentioned, my name is Megan Hubbard, and I'm here today with my colleague, Laura Meese, who you'll meet a little bit later. And in this next segment, we're going to discuss recent developments in fiduciary litigation and case law and lessons that practitioners can take away when advising fiduciaries and beneficiaries in trust and estates matters. The outline we'll discuss today, as Bill mentioned, is developed over time by monitoring cases across the country by our fiduciary services, fiduciary advisory services team, and really covers the past year and a half of hot cases on hot issues, or issues that we view as interesting to trustees and beneficiaries. Laura and I picked a handful of the cases from your outline that we'll talk about today. We will leave many of the cases to your reading. We just can't cover them all in this session. So with that, I'll start with the first case of today. This is the Ron v. Ron case. And this is number 6 and 8 in your outline. One has the lower court opinion and then on appeal. And this is a Texas case addressing the role and duties of trust protectors. And I'm always happy to see additional guidance from the courts on the roles of a trust protector relative to a trustee and the fiduciary duties attendant to each roles. We have state statutes in some states, but not in all. And so the developing case law and trust protectors' roles is always interesting to see and to focus on. So in this case, Suzanne Ron and Avishai Ron were married in 1994. In 2012, Suzanne created an irrevocable trust for the benefit of her children. She named her husband, Mr. Ron, as trustee, and Gary Stein as trust protector. The trust agreement provided that the trust protector's purpose is to direct the trustee in certain matters concerning the trust and to assist, if needed, in achieving Suzanne's objectives expressed by other provisions of Suzanne's estate plan. The trust agreement also permitted the trust protector to add Mr. Ron, among others, as a beneficiary of the trust. The trust agreement stated that the trust protector's authority was conferred in a fiduciary capacity. And you'll recall, as I just mentioned, that some state statutes allow a settlor to designate whether a trust protector is a fiduciary. And so this trust instrument did have that designation and confer those fiduciary duties on the trust protector. So the Rons, happy couple, are happy for a while, but then in 2014, Suzanne files for divorce, and the divorce is finalized in 2017. Following the Ron's divorce, Stein, as trust protector, adds Mr. Ron, now the ex-husband, as an additional beneficiary of the 2012 trust. And this prompts Suzanne to sue Stein, the trust protector. She alleges that Mr. Ron improperly transferred large sums of the couple's community property to the 2012 trust throughout the divorce proceeding, and also alleged that Stein had assisted Mr. Ron in making those transfers. Suzanne further alleged that Stein had breached his fiduciary duties to her as the trust protector. And remember, in this situation, Suzanne's only role with respect to the trust is as trust settlor. Now, as I mentioned at the outset, this is a Texas case. And in Texas, the law recognizes two types of fiduciary relationships: formal fiduciary relationships and informal fiduciary relationships. A formal fiduciary relationship is expressly created by law or the terms of an agreement, such as a trust agreement that we're all very familiar with. An informal fiduciary relationship arises from a special relationship of trust and confidence. And the court concluded that Stein, as trust protector, was a fiduciary, consistent with the trust agreement provisions, itself stating that he had fiduciary duties. However, the court held that under the trust agreement and the Texas statute governing trust protectors, Stein's fiduciary duties were owed to the trustee and not to Suzanne. And the court noted that the trust agreement stated only that a beneficiary or interested party could compel the trust protector to take action. So the court found that Suzanne was not an interested party in any way and had no standing to sue the trust protector. Because the trust agreement stated that Suzanne had no interests or incidents of ownership, she could not compel the trust protector to take any action either. Next, the court concluded that Suzanne failed to demonstrate an informal fiduciary relationship between herself and Stein, the trust protector. The only evidence of a special relationship between Suzanne and Stein, the trust protector, was her appointment of Stein to that role. And under Texas law, a special relationship of trust and confidence must actually exist prior to and apart from the creation of the trust, which Suzanne did not establish, and she didn't actually sufficiently allege it in her complaint either. So because of that, the court dismissed the breach of fiduciary duty claims. And interestingly, in this case, the court really did not discuss whether the trust protector owed fiduciary duties to the beneficiaries of the trust. Presumably, the trust protector did because of the language in the trust agreement itself, but this typical discussion that we see in the opinions discussing the role of trust protectors was absent here. And instead, the court really characterized the trust protector as really almost an agent of the principal trustee as the grounds for holding that the trust protector owed fiduciary duties to the trustee. So a little different analysis and focus than some of the other cases we've seen in the past discussing the duties of trust protectors. The next case I will jump to is the Gowdy v. Cook case, and this is number 19 in your outline. This is a Wyoming Supreme Court case dealing with when a no contest clause provision in a trust agreement is triggered. And there are several cases in your outline today that I will discuss dealing with no contest clauses. The enforceability of these clauses in different jurisdictions is really being tested in the courts, and we're seeing many opinions dealing with this issue. In this case, in 1996, Marion Jackson retained Dennis Cook to provide estate planning until her death in 2015. Dennis drafted a revocable trust agreement and various amendments for Marion over the years. Marion was trustee and primary beneficiary of the trust during her life. At her death, the trust assets were retained for the benefit of her longtime domestic partner, Gerald Gowdy, for Gerald's life. Marion named her attorney, Dennis, as successor trustee to serve after her death, and Dennis's brother-in-law partner as her trust protector. The trust contained change of trustee provisions, express language allowing resignation of the trustee and removal of the trustee by the trust protector, but required that any successor trustee be a corporate trustee with assets or insurance coverage of at least $100 million. The trust agreement also included a no contest clause, providing that certain challenges to provisions of the trust would result in forfeiture of the challenger's interests under the trust. So following Marion's death, Dennis began serving as trustee, and Craig, his brother-in-law partner, began serving as trust protector. The trustee, Dennis, had also prepared various documents for Gerald over the years, and after Marion's death, worked with Gerald to update his own documents. Several months later, Gerald complained that the trust established by Marion was being mismanaged and asked Dennis to resign as trustee. Dennis refused. He also asked Dennis's brother and partner, the trust protector, to remove Dennis. The trust protector also refused. So a year later, Gerald filed a complaint in the District Court of Wyoming alleging malpractice, breach of fiduciary duties, breach of the duty of good faith and fair dealing, and negligence related to Dennis's drafting of both Marion's trust agreement and Gerald's own estate planning documents, and also alleging breach of duty in the Cook's administration of Marion's trust. So his claims for breach were based on both the drafting at the inception and also the administration of Marion's trust. Gerald sought various forms of relief, including a request that the district court modify the trust to repair issues due to Dennis's drafting errors. Gerald's proposed modification would remove the requirement that the corporate trustee have assets or insurance coverage of at least $100 million. In response, Dennis, as trustee, counterclaimed in seeking a declaratory judgment that under the no contest provisions, Gerald had forfeited his rights as trust beneficiary by requesting removal of those corporate trustee requirements. And the district court in Wyoming agreed and found that Gerald had forfeited his rights under the trust agreement. Gerald appealed and argued that the no contest clause should only apply to challenges to distributions from the trust, so trust administration by the trustees, and not his attempts to repair alleged drafting errors by Dennis. The Supreme Court of Wyoming disagreed with Gerald and affirmed the trial court's decision. Gerald's attempt to remove certain corporate trustee qualification requirements was an attempt to nullify a provision of the trust agreement, thereby triggering the no contest clause. The Supreme Court of Wyoming also rejected Gerald's argument that the no contest provision should be applied only to challenges to distributions, because Marion's intent, as evidenced by testimony during a summary judgment hearing, supported that construction of the clause. The Supreme Court found that Marion's objective intent was evidenced by the plain language of the trust agreement, which, when read as a whole, unambiguously stated that beneficiary would forfeit his interests if he attempted to void, nullify, or set aside any provision of the trust agreement. So Wyoming seems to be a jurisdiction where settlers' intent is paramount, and no contest clauses are vigorously enforced. As we know, courts in other jurisdictions mention strictly construing such clauses, or even good faith and probable cause exceptions, but not in Wyoming, which is too bad for Gerald. From a practical perspective, this opinion outlines, the importance of addressing no contest clauses when parties, trustees, and beneficiaries desire to modify a trust, even if such modification could arguably otherwise be consistent with the material purpose of the trust. I think also arguably, if there is a no contest clause in a trust instrument, any modification could violate a material purpose of the trust, making modification inappropriate in a non-judicial settlement agreement. So interesting to think about. Of course, that determination would ultimately depend on the exact language of the no contest clause at issue. The next case I will cover today is Hunter v. Hunter. This is number 18 in your materials. This is another case, this one from the Supreme Court of Virginia, dealing with no contest clauses in a trust agreement. In this case, Teresa Hunter created a revocable living trust in 2011. Under the trust agreement, following her death, the remaining assets were to be distributed in equal shares among her granddaughter and two children, Chip and Eleanor. The trust agreement contained a no contest clause. Teresa died in 2015, and Eleanor became successor trustee of the trust. After Teresa's death, Chip received an account statement for the trust that showed the trust assets had declined from $4.25 million to $1.77 million over a 6-year period. And after receiving this account statement, this prompted Chip to request additional information from Eleanor as trustee, including a report of the trust receipts and disbursements during that time period. Eleanor refused to provide this information, relying on a provision of the trust agreement that waived the trustee's formal requirements to inform and report to a beneficiary under the Virginia Uniform Trust Code. Chip then filed a lawsuit in the circuit court asking the court to confirm that the trust agreement did not waive Eleanor's duty to provide financial information about the trust. However, Chip, in order to avoid the trust agreement's no contest clause, he divided his complaint into 2 counts. And in count 2, Chip asked the court to answer the question ultimately at issue, whether the trust agreement waived Eleanor's duty to provide the requested financial information. But in count 1, Chip asked the court to first determine whether addressing count 2 would trigger the no contest clause. If the court determined that addressing count 2 would trigger the no contest clause, then Chip asked the court not to rule on count 2 at all. And that was the intended effect of including count 1 in the complaint. So Eleanor, this is at the circuit court level, filed a counterclaim alleging that Chip's complaint triggered the no contest clause and that Chip had forfeited his interests in the trust. And the circuit court agreed with Eleanor and held that Chip's complaint had triggered the trust no contest clause, and therefore Chip had forfeited his entire interest in the trust. And Chip appealed to the Supreme Court of Virginia. So in Virginia, no contest clauses are valid and enforceable, though courts will strictly construe those clauses. And ultimately, the Supreme Court of Virginia reversed the trial court's decision. First, the Supreme Court held that Chip could plead in the alternative, as he had done. So that is, Chip could ask the trial court to rule on count 2 whether the trust agreement in fact waived Eleanor's duty to provide financial information, if and only if the court determined that the request would not trigger the trust agreement's no contest clause. Because the trial court had concluded that Chip's complaint triggered that no contest clause, it should not have reached count 2 at all. Instead, the trial court's analysis should have ended with resolution of count 1. The court further held that Chip's complaint, getting to the merits of count 2, did not trigger the no contest clause. The no contest clause in the trust agreement sought to prevent actions to contest the trust agreement. And instead, the court found Chip was seeking to determine the meaning of the trust agreement and not to actually challenge its terms. So therefore, Chip's lawsuit was an action for construction and did not trigger that no contest clause. Notable as well, the Supreme Court did not rule on whether Virginia law would allow the trust agreement to prohibit a suit to construe the terms of a trust agreement. The Supreme Court appeared to suggest that it would take a skeptical view of such efforts to really effectively seal the courthouse doors. That's the language it used in its opinion. The court also did not have occasion to rule on whether the trust agreement could effectively waive the trustee's duty of disclosure in its entirety. In Virginia, the common law set forth in Fletcher v. Fletcher says that beneficiaries are entitled to information sufficient to protect their interests. Under the Virginia Uniform Trust Code, however, the provisions outlining a trustee's duties to inform and report are not mandatory provisions. Rather, they're the default rules. The Virginia Supreme Court actually did note this issue and said that it would be an issue of first impression for the Virginia Supreme Court, and thus was not appropriately addressed on appeal. However, I think based on the court's disfavor of sealing the courthouse doors in the language of the opinion, there is a suggestion that not providing any information whatsoever to a beneficiary regarding the administration of the trust may, effectively seal the courthouse doors to a beneficiary in another way. So by removing that beneficiary's ability to receive information and enforce his or her interest, and therefore would be impermissible, absent information being sent to a trust protector, for example. But we'll have to wait for another case squarely addressing this issue for further guidance in Virginia, at least. Looking at this case from another angle, it highlights, I think, problems fiduciaries often face, which is pressure or insistence from a grantor or co-trustee not to disclose significant events in the administration of a trust to beneficiaries, generally to remainder beneficiaries when there's some, as I said, pressure from a grantor or a family co-trustee. And this pressure, creates a difficult situation for a trustee by not disclosing, but also maybe both a violation of Virginia law, depending on the terms of the trust, but also notably renders defenses and mechanisms that could shorten the statute of limitations period for a trustee to be sued for certain actions, unavailable to a trustee. As we know, proper disclosure under the Uniform Trust Code can limit the time period for bringing a breach of fiduciary duty claim to just 1 year, which can significantly mitigate risks for fiduciaries in administering trusts and provide defenses if the fiduciary ever does end up in court. So some competing interests and concerns there, certainly. The next case I'll discuss is Ferguson v. Ferguson, and this is number 24 in your materials. This is from the Supreme Court of Idaho, another case discussing beneficiary standing, trust records, and no contest clauses. Here, Roger and Sybil Ferguson created a joint family revocable trust. They named their children and grandchildren as ultimate beneficiaries upon both of their deaths, but excluded their son, Michael Ferguson. The original trust would become irrevocable upon the death of the first grantor, and the assets would then be divided into 3 subtrusts: the family trust, the marital trust, and the survivor's trust. Roger Ferguson, the first grantor, died in April of 2012, and 18 months after his death, Sybil had a change of heart and decided to add Michael as the beneficiary of one of the subtrusts, the survivor's trust, by exercising a power of appointment granted to her in the trust agreement. And this exercise was done in her will that was executed in October of 2013. And as a result, Michael would ultimately be entitled to a share of the assets remaining of the survivor's trust at Sybil's death. He had no interests during Sybil's life. Sybil was the sole beneficiary during her lifetime. Sole current beneficiary, excuse me. The trust contained a no contest clause, as I mentioned before. Sybil died in 2015, and her will was admitted to probate in Arizona. 3 of her children, not Michael, were named and qualified as executors of her estate in Arizona and as successor trustees of her subtrusts, including the survivor's trust. Michael then requested financial information regarding the original trust and all of the subtrusts dating back to the father's death in 2012. And a dispute arose over the scope of the trust information that he was entitled to receive, which prompted Michael to file a petition in Idaho, the situs for the survivor's trust, for an accounting seeking to review any and all allocations made to those subtrusts pursuant to the trust agreements. Essentially, Michael was seeking information to confirm he received his full share of the survivor's trust. The successor trustees responded, providing information relating to the administration of the trust, beginning with Sybil's death in 2015, but refused to go before that point in time. So separately, while the Idaho matter was pending, Michael filed a claim against Sybil's estate in Arizona on grounds that he was a creditor because Sybil had breached fiduciary duties owed to him as a beneficiary of the survivor's trust. So Sybil, maybe questioning her choices. After procedural back and forth in the Arizona proceedings, the parties ultimately agreed to stay that case while the Idaho case was resolved. In the Idaho matter, the successor trustees filed a cross motion for summary judgment asserting that by filing the Arizona probate claims, Michael had violated the terms of the no contest provisions and forfeited his interest in the survivor's trust. The magistrate court in Idaho found that the probate claim did not violate the no contest clause because Michael was attempting to ascertain the full extent of his interest rather than contesting the validity of the trust. But the magistrate did grant the trustees' motion for summary judgment with respect to Michael's request for information on grounds that Michael did not become a beneficiary of the survivor's trust until after Sybil's death, and therefore was not entitled to the pre-2015 records. The magistrate also held that Michael lacked standing for an accounting prior to that time period for the original trust, the family trust, and the marital trust, because he had never been a beneficiary of those trusts. Both sides appealed, and the district court affirmed the magistrate in part and reversed in part. The district court found that Michael became a beneficiary when Sybil exercised the power of appointment in her will in October 2013. The court found that Michael Ferguson was a beneficiary of the survivor's trust for approximately 18 months before Sybil Ferguson's death, and during this period had the same right to seek relevant records and information about the assets and particulars of the survivor's trust. One strange part of this opinion is that the exercise of the power of appointment by Sybil's will was fully revocable and could have been changed until she died. So the court's analysis is a little unusual. Next, the court considered whether Michael was entitled to records regarding the original trust and found that, yes, Michael was entitled to records from 2013 on, and that 2013 was when the first grantor died. The court found that the Idaho Trust Code does not place temporal limits on information a beneficiary is owed, and also found that contingent beneficiaries and vested beneficiaries are on equal footing with respect to requests for information under the Idaho Trust Code. In allowing Michael's expansive information requests, the court really hung its hat on the fact that the trust became irrevocable when the first grantor died. The court also relied on Michael's status as a beneficiary as of 2013 when Sybil included Michael as a beneficiary in her will for the first time. So while this result is okay because Michael ultimately ended up with a vested remainder interest, the reliance seems a little misplaced to me because Sybil's designation could have been revoked until her death in 2015 when her will became effective. This case, I think, also illustrates the difficulty of joint trust with more than one grantor. Lastly, on the no contest clause issue, the Idaho court found that Michael's actions fell within the scope of the no contest clause, but found that it was not enforceable because it interfered with the enforcement of and proper administration of the trust. The court noted, and I'm going to quote this, instead of producing the information, the trustees sought to prevent Michael from obtaining the information through the forfeiture provision. Put differently, the trustees are attempting to use the forfeiture provisions to remove Michael as a beneficiary as a penalty for seeking records pertaining to the administration of the survivor's trust. The enforcement of the no contest clauses was actually an issue of first impression here in Idaho, in Idaho. And the court took a much narrower approach than the Wyoming or even the Virginia courts, finding the beneficiary's request could not violate a no contest clause, even if the action was arguably captured by the language of the clause itself. With that, I will turn it over to Laura Meese to continue our case discussion.
Thanks, Megan. And as Megan said, I'm Laura Meese. The first case I'm going to discuss is Wilburn versus Mangiano, which is number 7 in your outline and is out of the Virginia Supreme Court. This case involves an option to purchase property in a will where the purchase price was set at fair market value. Fair market value is a common phrase that we often see in wills and trust agreements. And at first glance, it's a phrase that seems perfectly reasonable to set a purchase price for property to be sold at a later date. But as this case will teach us, that's not always the case. So in 2002, Jeannie Mangiano executed a will wherein she left her residence to her 3 daughters and granted her son, Anthony, an option to purchase the property from his sisters. Under the terms of the will, Anthony could exercise the option within 1 year from the probate of Jeannie's will at a price equal to the property's real estate assessment in the year of her death. 3 years later, in October 2005, Jeannie executed a codicil that revised the purchase price to an amount equal to the fair market value at the time of Jeannie's death. Jeannie died a month later in November 2005. Shortly thereafter, Anthony sent a letter to his sisters to serve as legal notice of his intent to exercise the option to purchase under the terms of the will or the codicil, whichever was set found to be valid. Anthony also filed a suit to set aside the codicil, but the jury determined it to be valid. The sisters then filed a suit to compel Anthony to purchase the property in accordance with the exercise of his option. The sisters alleged that they had obtained 2 appraisals of the fair market value of the property at their mother's death, one which valued the property at $311,000 and the other at $270,000. They requested that Anthony be compelled to specifically perform. Anthony filed a demurrer. He contended that there was no enforceable contract because an amount equal to the fair market value at the time of his mother's death was not a sufficiently specific term to establish mutual assent as to the purchase price of the property. The trial court sustained Anthony's demurrer and entered an order dismissing the case with prejudice. The trial court held that there was no enforceable contract because the will, the codicil, and the notice of acceptance did not determine the purchase price, nor did they provide a method for determining the purchase price. The sisters appealed. Under Virginia law, it's a well-established tenet that price is a material term of a contract and that it must be specified in the agreement itself, or the agreement must provide a mode for ascertaining the price with certainty before a court will compel specific performance. Generally, the fair market value means the price that a seller is willing to accept and a buyer is willing to pay on the open market in an arm's length transaction. Ultimately, the Virginia Supreme Court upheld the trial court's decision and held that the phrase fair market value on a specific date without any more specificity was not a sufficiently certain price to allow any court to compel specific performance of a contract regarding the purchase of real estate. In considering whether the term fair market value in these circumstances is sufficiently specific, the court relied on the fact that there's no single fixed approach to determine fair market value. Rather, Virginia courts recognize a variety of approaches, such as the cost approach, the income approach, the sales approach, and the comparable sales approach. Given the multitude of valuation approaches recognized by Virginia courts, the Virginia Supreme Court found that without additional specification, the term fair market value on a specified date failed to provide a mode for ascertaining the price, which would allow a court to compel the specific performance of Anthony's option. The takeaways from this case is a reminder that when property owners wish to sell their property when they pass away, or they're unable to decide on an appropriate purchase price, if you're going to offer it at fair market value, a concrete valuation method should be clearly spelled out in the relevant estate planning documents. For example, you could require that at least 2 independent appraisals be done and the mean of the 2 prices be used. You could also get more specific and list the type of approach that should be used, such as the cost approach, the income approach, or the others. Another simple option could be to tie the definition of the fair market value to the tax assessment value, such as what Jeannie had done in her will, but then had revised it with the codicil. If the tax assessment values are traditionally too low or too high in the area, you could spell out an approach in which you add or subtract an additional percentage of the price to the tax assessed value to get closer to what you believe is a more accurate fair market value of the property. The next case I'm going to discuss is Platt v. Griffith, which is number 17 in your outline, and it is another case out of the Virginia Supreme Court. It relates to a court's jurisdiction over fiduciary disputes, specifically who has standing to bring a suit on behalf of an estate. Dr. Griffith executed a will leaving his residuary estate, including a 704-acre farm, in a lifetime trust for the benefit of his second wife, Mary Kate. Under the terms of his will, if Mary Kate predeceased Dr. Griffith, the farm would pass to Dr. Griffith's son, Charles, apart from two 10-acre parcels, one for each of Dr. Griffith's 2 daughters. 2 years later, in 2010, Dr. Griffith executed a new will, which revoked and replaced all prior wills. Under the 2010 will, each daughter would receive a 20-acre parcel of the farm, with the remainder of the residuary estate, including the rest of the farm, passing to Charles and Mary Kate. 6 years after that, in 2016, Dr. Griffith executed a deed of gift, giving the entire 704-acre farm to Charles and Mary Kate. Mary Kate received a life estate and the remainder went to Charles. The 2016 deed was silent as to the two 20-acre parcels in Dr. Griffith's 2010 will left to his daughters. 6 months later, Dr. Griffith died, and he was survived by Mary Kate, Charles, and the two daughters. Initially, Dr. Griffith's 2008 will was probated. However, Charles, in his capacity as personal representative of the estate, later filed a suit requesting to probate the 2010 will. The daughters unsuccessfully challenged the validity of the 2010 will, and they did not appeal that trial court decision. In 2018, the daughters sued Mary Kate and Charles in their individual capacities, seeking a declaration that the 2016 deed of gift was void. The daughters alleged that Mary Kate and Charles conspired to convert $13 million of Dr. Griffith's assets and use their confidential relationship with Dr. Griffith to unduly influence him into signing the 2016 deed of gift. Mary Kate and Charles, in their individual capacities, moved to dismiss the daughter's complaint for lack of standing. The circuit court dismissed the complaint with prejudice, noting that the transfers at issues occurred during Dr. Griffith's lifetime. Accordingly, the circuit court concluded that only Dr. Griffith's personal representative could bring the claims. And the circuit court specifically held that the daughters did not have any right, title, or interest to the property at issue, and moreover, the 2016 deed of gift extinguished the prior testamentary gift of the two parcels of the farm in his 2010 will. The daughters appealed and argued that they were vested beneficiaries of two 20-acre parcels of the farm and therefore had standing to pursue the rescission of the 2016 inter vivos deed of gift. Under Virginia law, to establish standing, a litigant must show an immediate pecuniary and substantial interest in the litigation, and not a remote or indirect interest. The proper party to litigate on behalf of the state is the personal representative, not a beneficiary of the state, even when the personal representative is also a possible beneficiary. The Virginia Supreme Court ultimately held that the daughters lacked standing to seek rescission of the 2016 deed of gift. As potential beneficiaries under the 2010 will, the daughters' claim was only would indirectly benefit them. Rather, the entity that directly benefited would be Dr. Griffith's estate. Moreover, the rescission claim would have belonged to Dr. Griffith during his lifetime, and consequently, such claims are inherently on behalf of the estate. The daughters argued that it was unreasonable to expect Charles, as a personal representative, to pursue these claims on behalf of the estate when the alleged misconduct directly benefited Charles and he was the perpetrator. The Supreme Court dismissed these concerns because they pointed to the proper way to address this was to file a petition to remove and replace Charles as the personal representative, which the daughters failed to do. Ultimately, the Supreme Court held that Charles, as this personal representative, even though he was the perpetrator of the alleged misconduct, was the only one who had standing to seek rescission of the 2016 deed of gift. Moreover, in a footnote, the court also noted that the daughters were not, in fact, vested beneficiaries of the two 20-acre parcels of the farm. The two parcels were conveyed by the 2016 deed of gift, and because of this, they were not part of Dr. Griffith's estate, and thus the daughters' interests never vested. This footnote is a good reminder that a specific bequest is revoked if the testator disposes of the property prior to his death. This principle is called ademption by extinction. More generally, it's a reminder that a will only controls the assets that are actually part of a decedent's estate at death. If an individual uses probate avoidance strategies like beneficiary designations or transfer or payable on death accounts or joint ownerships with rights of survivorship, these assets will pass outside of probate and will not be controlled by the will. Thus, it's important to remember wills are just one component of an estate plan. The next case that I'm going to discuss is Trowbridge versus the estate of Trowbridge, which is number 25 in your outline, and a case out of the Indiana Court of Appeals. The case relates to lost wills and the presumption of revocation. Everett Trowbridge and Crystal Trowbridge married in 2003 and divorced in 2012. But despite their divorce, the two remained on good terms. In fact, approximately 2 months after their divorce was finalized, Everett executed a will in which Crystal and Everett's brother Michael were named as executor. Under the 2012 will, Everett left to Crystal the party's former marital home, which Everett received according to a dissolution order, but which Crystal never deeded to Everett as required by the dissolution order. Crystal also received the entirety of one retirement account, 25% of a second retirement account, and all of Everett's personal property. Under the will, Michael only received 75% of the second retirement account. Everett subsequently died in 2018. A few weeks later, Michael filed a petition for the issuance of letters of administration asserting that Everett had died intestate. The probate court granted Michael's petition and appointed him personal representative of Everett's estate. Several months later, Crystal filed a petition for probate of will and appointment of co-personal representative with the probate court. She asserted that Everett died testate pursuant to the 2012 will. Michael objected to the probate of the 2012 will. And in the probate court hearing, Crystal, Michael, and an attorney for the estate testified to the facts and circumstances surrounding the execution of the decedent's original will and its status as of the date of his death. After the hearing, the probate court entered an order denying probate of the will on the basis that the presumption of revocation applied, where the will was in the possession of Everett and was missing at the time of his death. Crystal appealed the decision, and the Court of Appeals in Indiana reversed and remanded, finding that the estate had not been entitled to the presumption that the original will was destroyed with the intent to revoke without predicate factual findings. The probate court then held a second hearing during which Crystal, Michael, and the estate's attorney testified to additional facts and circumstances regarding the status of the will. The evidence established that the will offered by Crystal was a copy of Everett's original will, which at one time had been kept in a safe at Everett's home. But after Everett's death, the will was not found when Michael searched the safe and home. The probate court concluded that because Crystal failed to prove by a preponderance of evidence that the will she offered for probate was the original will, she had not overcome the presumption of revocation, and it entered an order denying probate of the will. Crystal again appealed the decision of the probate court. Under Indiana law, when a copy of a will is offered for probate in place of the original, a contesting party has the burden of establishing that the original will was revoked. However, where a testator retains possession or control of the will, and then the will is not found at the testator's death, a presumption arises that the will was destroyed with the intent to revoke it. Such presumption shifts the burden to the proponent of the will to prove by a preponderance of the evidence that the testator did not destroy the original will with the intent to revoke. Evidence that can rebut the presumption of revocation includes evidence of the testator's intent when he allegedly revoked the will, evidence relating to the ability of the testator to obtain access to the will during the period of revocation, evidence relating to the competency of the testator during the alleged period of revocation, and evidence relating to the ability of the interested parties to obtain access to the will before its disappearance. The Court of Appeals affirmed the probate court's holding that the estate was entitled to the presumption of revocation based on the findings that the original will had been in Everett's possession, that Crystal had offered a copy of the will for probate, and the original will could not be found at Everett's death. However, the Court of Appeals also held that the probate court erred in denying Crystal's petition solely because she was unable to offer Everett's original will. Rather, the Court of Appeals concluded that the probate court should have engaged in a burden-shifting analysis set forth in the Estate of Fowler, an Indiana Court Appeals decision from 1997. Specifically, the probate court should have determined whether the testimony and exhibits offered by Crystal could rebut a preponderance of the evidence presumption that Everett's will was destroyed with the intent to revoke. In coming to this conclusion, the Court of Appeals noted several facts in the record that could rebut the presumption of revocation, including the fact that Everett did not execute his will until after the divorce had been finalized. Everett continued to list Crystal as the beneficiary on his accounts after the divorce and as recently as 2018, the year of his death. Everett also never enforced the dissolution order, which required Crystal to deed the former marital home to him. Everett also never informed Crystal that he revoked the will, and Michael had access to Everett's home and safe immediately following Everett's death. And finally, Michael stood to gain more under the intestacy laws than if the will were borrowed from probate. Accordingly, the Court of Appeals reversed the probate court's decision on this issue and remanded the case for further proceedings. It's important to highlight the fact that if the probate court found that the evidence Crystal presented rebutted the presumption of revocation, the burden of proof would then shift back to Michael to prove that the will had in fact been revoked. There are two lessons here for estate planning. First, always know where the original copy of the will is. And second, be aware of the procedural rules that govern wills. There are procedural rules that shift the burden of proof from one party to another, and this shift could be the reason that the wishes of a testator are not followed. The last case I'm going to discuss is Burgess v. Johnson, which is 31 in your outline, and is a 10th Circuit case interpreting Oklahoma law. The case relates to an arbitration clause in a trust agreement. The facts of this case are pretty simple. Howard Johnson served as sole trustee of a trust created under Oklahoma law. In May 2019, the beneficiaries of the trust sued Johnson in federal court, alleging he had breached his fiduciary duties by wrongfully taking trust assets. Johnson moved to compel arbitration of the beneficiary's claim. He cited a provision of the trust agreement that authorized him, in his sole discretion, to compromise, contest, and submit to arbitration or settle all claims by or against and all obligation of the trust estate or the trustees. The District Court for the Northern District of Oklahoma denied Johnson's motion to compel arbitration. Johnson then appealed to the 10th Circuit Court of Appeals. A court will apply contract law's principles to analyze an agreement to arbitrate claims. In construing the terms of a contract, the document's plain language govern its interpretation. The 10th Circuit affirmed the District Court's denial of Johnson's motion to compel arbitration. The 10th Circuit found that the arbitration provision merely granted the trustee with a range of options to resolve disputes, which also included the power to compromise and settle claims, but the trust agreement did not empower Johnson to compel others to arbitrate claims. In reviewing the arbitration provisions, the court noted that the provision applied to the beneficiary's claims as well as claims involving third parties who had no interest in the trust. Because the arbitration provisions clearly did not, and moreover could not, allow the trustee to compel a third party to submit to arbitration, the court found it unlikely that the grantor had intended the arbitration provision to require the beneficiaries to arbitrate claims against the trustee. This case is a reminder that at the end of the day, a trust agreement is a contract between a trustee and a grantor, and as such, contract law principles will apply. It's also a reminder that before an entity accepts a trusteeship, they should carefully read over the administrative terms which many laypersons skim over and or do not fully understand. And with that, I want to thank everyone for coming today and remind you that we will be sending out materials and a link to the full recording. Thank you very much.